And as the participation, the proportion of the participation of the entrepreneur in the capital project is equal to his participation in the loss and the potential loss, so we can get the first element of our profit sharing contracts, which is alpha 1, and differently the ratio of sharing loss or the ratio of participating into the capital project. The second, and it's my first result. The second element of the sharing contract is the profit sharing ratio. To obtain it, we have to find the solution of a bank optimization program which take this form. It's a very simple optimization program in which the bank should maximize his expected profit. The first equation is his expected profit, but the bank is constrained by the acceptation of the entrepreneur to conclude this contract. And the entrepreneur accepts to conclude the sharing contract if his nonlinear expected profit at the left side of the second equation is at least equal to his replacement income. And I mean by replacement income, a salary that the entrepreneur can get if he doesn't conclude the sharing contract and work as a salary manager. Plus, random revenue the entrepreneur can get by placing the equivalent of his participation in the project capital. He placed this amount in a market portfolio without guaranteed the revenue of this placement. To specify the attitude of the entrepreneur toward risk, I have chosen a monetary function, one of the monetary function, which is the anthropic function. This function is interesting because it has a feature, very interesting feature. It's invariance by translation. Invariance by translation means that the utility of a random amount x plus a certain amount small e is equal to the utility of the random amount plus the guaranteed amount. In other words, the agent cannot obtain a remuneration in a given amount only if, or can obtain a remuneration only if he takes a contractual risk. And this corresponds perfectly to the prohibition of risk, to the prohibition of interest. So we can perfectly, with this type of function, describe the choices, the preferences of an agent constrained by prohibition of interest. So the solution of this program optimization can be obtained in this form. Our optimal sharing ratio, alpha 2, take this firm, I will assume that my random variable z has a probability distribution gamma law, and I can write my sharing ratio like this. Unfortunately, I cannot get an explicit solution for this sharing ratio, so I am obliged to calculate it numerically. I take other values for all independent variables, and I calculate one or several values of the sharing ratio. I do it in function of the risk tolerance of the entrepreneur, and I can get several value of alpha to this profit sharing ratio. So my second result is that we can obtain this profit sharing ratio independently of interest rate or any other financial opportunity cost. And I think it's the first time in the literature where we have the sharing ratio independent of these two determined interest rate or a given opportunity cost of financial capital. 5. In fact, this sharing ratio, in this sharing ratio, we can say that it's determined by several factors. The parameter of gamma law, which express our expectation concerning the profitability of the project, the risk tolerance of the entrepreneur, the participation, alpha 1, the participation of the entrepreneur in the capital project. But there is another component that we cannot say directly in this sharing ratio, in this profit sharing ratio. And its component is related at what I call the asymmetrical nature of sharing contracts. To show this, I rely on a variable of sharing contracts, which is mudaraba. And in mudaraba, there is no participation of the entrepreneur in the capital project. So no participation equal to the capital equal no participation to the potential loss. I present the profit profile of the entrepreneur for this contract, mudaraba, in the first equation. And the second equation, I present a profit profile of an hypothetical symmetric mudaraba. It doesn't exist. It's just an instrumental tool I use to show this asymmetric nature. If the bank can propose to the entrepreneur a contract with no participation in the capital, but with a participation to the potential loss proportional to his participation in the profit, we can obtain an alpha star, which is a ratio of sharing profit and loss in the same time. For the same entrepreneur and the same project, the bank can propose the traditional, the classical mudaraba expressed in the first equation. And necessarily, the alpha of mudaraba, the profit sharing ratio of mudaraba, is less than the profit ratio of the symmetrical contract. We can show this in a very simple manner. And the difference between these two sharing ratio is what I call a quasi-default premium. It's similar to default premium, but expressed in expected term, because it's not a guaranteed premium. It's just an expected premium because it's expressed in reducing the sharing, the profit sharing ratio. 2 minutes. So, and it's my third result. I have no time to present the fourth part of this paper. I go directly to conclusion. So in this paper, I have tried to formulate an optimal sharing contract that allows me to obtain an optimal participation of the entrepreneur in the project capital, a profit sharing ratio independent of interest rate and any other financial opportunity cost. We can calculate with this approach a quasi-default premium that compensates the asymmetrical nature of sharing contracts. In the fourth part, I discussed the condition of renegotiating contracts that show a flexibility of implementing this contract. And finally, I should just mention that beyond specificities of Islamic law, this paper presents an attempt to formulate an optimal financing contract. And thank you.
Thank you so much. The discussant for this paper is Mohammed Shahid Ibrahim.
आप चाहें तो कर सकते हैं हाँ ये चेक करिएगा ज़रा चेक कर लें PDF है Pocket.
Just one minute. Yes, I thank the sponsors for inviting me to discuss this paper. The paper basically presents a stylized model of a medieval partnership organizational form of musharaka, when an entrepreneur basically negotiates a distinct profit and loss sharing ratios with a financier. The author rationalizes his study based on nostalgia. This is because the organizational form was employed in the era of the Prophet and the pious predecessors, that's basically self-following, and currently has gone out of vogue as stated by the author due to the change in economic environment, information asymmetry, and enhanced risk of contracting parties in the introductory session. Accordingly, the author employs recent advances in mathematical finance, which mitigates information asymmetry, employing conventional incentive theory, and he also prices loss and profit sharing parameters for risk-averse economic agents. The risk-averse constraints on agents is relaxed, and the pricing is extended to risk-neutral agents for specialized silent partnership, where the capital contributions solely emanate from the financier. Finally, the contract breaches are studied in Section 5. So, coming to the comments on the paper, one is, I believe, I went through the paper a couple of times. The paper is not written very well and has numerous mistakes such as missing references. The moderation of information asymmetry using the incentive theory is not articulated well enough. The agency issues between the entrepreneur and financier are also neglected. I mean, in the same literature, you'll find, the authors typically neglect agency issues. Agency issues are quite important, and they are distinct from information asymmetry. Second, the literature review in the introduction and section is very weak. The comprehension of the history of organizational forms even prior to Islam is necessary for such a study. And this is elaborated in Udovich, that's basically Abraham Udovich, who states that one must bear in mind that an institution like partnership was not an innovation of or in any way peculiar to Islamic law. It was known and practiced in the Near East, at least since the Babylonians. It is known and discussed even in the Talmud, and it is treated in the Corpus Juris Civilis of Justinian. It appears almost certain that various forms of business associations were practiced by Meccan merchants in the period immediately preceding Muhammad. The partnership form is recognized and approved in Quranic texts as well as the prophetic traditions and the consensus of the Islamic jurists. This is only due to the fact that it facilitated trade in the medieval era. It's further accommodated in Islamic law as elaborated further in Udovich as follows. Classical Islamic law as we know it today was created during the first 2 centuries of the Islamic era. It was to a large degree non-Islamic, but was subject in one degree or another to an Islamicizing process. By the end of the second Islamic century, we find that all major Islamic positive legal institutions already formulated as were its legal theory and jurisprudence. Second issue is, I don't buy the reason given by the author why the traditional forms, organizational forms in Islam have gone out of vogue, as described on page 2. A deeper understanding of given in one of my papers, 2015 paper, as follows. The traditional partnership form emanated in basically a rudimentary economy where a trader financed his or her working capital and distributed the profits after a recoupment of the original capital. In contrast, in a modern or advanced organizational form such as a C corporation, retiring the original investment and distributing profits is an extraordinary exception, as the entity is considered to be a long-lived one. Furthermore, C corporation has the following additional comparative advantages over a musharaka. One is limited liability. Second is ease of transferability, liquidity of shares ensuing from a secondary market. And the third issue is centralized management. This issue is quite vital for emerging Muslim economies, as the continuous emphasis on medieval organizational forms such as musharaka and mudaraba for nostalgic reason can perpetuate the current underdevelopment of these nations. This is because organizational forms along with optimal financial instruments can allow businesses to competitively deliver products and services demanded by their customers at the lowest cost by mitigating transaction cost. It was a classic paper by Coase and Alchian early on. Coase was 1937, Alchian was 1950. The above view is reinforced in Joseph Sachs' very well-known study, who states the following: Islamic law, which until the early Abbasid periods had been adaptable and growing from then onwards, became increasingly rigid and set in its final mold. It was not altogether immutable, but the changes which did take place were concerned more with legal theory and the systemic superstructure than with positive law. Taken as a whole, however, Islamic law reflects and fits the social and economic conditions of the early Abbasid period, but has become more and more out of touch with later development of state and society. It is this very rigidity in Islamic law that led in part to the deterioration of the early Islamic financial instruments, institutions and markets, leading to the eventual decline of the Muslim world as described in Timur Quran. To conclude, I need to draw the attention of the author to a very important statement made by Hassanuz-Zaman in his 1990 study and published in the Journal of King Abdulaziz University, where he stresses that the importance of the classical equity facilities in Islam has been overemphasized. Hassanuz-Zaman basically states that shirka and mudaraba are not sacred, nor are they the end of all financial or business relationship. I would therefore suggest to the author to work on modern organizational forms in conjunction with trading of financial claims conforming to the Quran and Sunnah to derive efficient stakeholder claims. This will help stem the tide of underdevelopment of emerging Muslim economies. I've stated the references at the back. Thank you very much.
Thank you. We have time for a couple of quick questions. There are. There's one right here. Microphone, please.
Yes, sir.
Thank you. Let me just make a comment in support of the author and contradict my respected colleague and friend Dr. Shahid Ibrahim. The fact that the contract mode is old is not sufficient ground to reject it. As a matter of fact, these old modes of contracting are making a comeback. One of the recent examples were that STC, Saudi telecom company, got into a simple mudaraba contract with a rajhi of 2 billion riyals. That's just a few years ago, but 2 or 3 years ago. I don't see any reason why this does not make a comeback again. The question is, who might succeed into getting to such contracts? It looks like that only big businesses can get such a facility from banks, but not the simple merchant or trader. Another point is that, if we're going to discard the heritage of the first 2 or 3 centuries, we will be wasting a huge fortune of Islamic jurisprudence with no alternative whatsoever. That's basically the golden period, the golden era of Islamic jurisprudence. Thank you.
Thank you. Would you like to comment? I'm not sure if it's working. You may want to come here.
A very short comment on the comment. The object of my paper is not to discuss legal issues. I have one question. I have tried to bring some element to answer to this question, if we can or not use sharing contracts to finance some projects. My answer is yes, and I try to show how this contract should be formulated. Does this?
Thank you. So in the, is the quick comment?
Very, very quick.
Okay.
Yeah, I just wanted to respond to Brother Osama. I want to ask him, I want to recommend him take a look at the books of Hadith, where there is a very famous Hadith by Al-Mu'mineen Aisha radhiyallahu anha. She talks about the Prophet sallallahu alaihi wasallam loved horses. But we do not ride horses anymore. If it's part of our history, it's part of the Islamic history, the Prophet ﷺ and the Salaf Salihin rode horses and camels, but we do not ride horses and camels anymore. Likewise, organizational forms basically, they change according to the economic era. If you look at even in the West, there's a C corporation, there's an S corporation, there's a master limited partnership, there is real estate investment trust, and there's an umbrella, you're familiar with real estate, there's an umbrella REIT. So organizational forms depend on the type of businesses, So that's what I conclude with. Thank you.
Thank you. We're getting into much deeper issues here. So I think in the interest of time, I'm going to move on to the second paper. And if we have time at the end, we can go back to this paper or the second paper. So our second paper will be on the optimality of sharing contracts. And our presenter is Abdullah Al-Mansour.
Okay, Bismillah ar-Rahman ar-Rahim. Good morning, gentlemen. I'm very pleased to be presenting before such an audience. I have only 20 minutes. I have to make it short and concise. The paper is about the optimality of sharing contracts. What motivates the paper is such a long argument against. What motivates this paper is such a long argument against sharing contracts. Here are two quotes, one from an economist and one from corporate finance scholars, citing the inefficiency of sharing contracts. The idea is very simple. If X is the level of effort, if Rx is the return on investment, if the CX is the disutility of effort, then a rational entrepreneur will maximize his function at X star. So if there is a sharing arrangement, then he would, at the first one, he would get the full marginal return of his effort. In the second one, under sharing arrangements, he is going to get only a fraction of the marginal return. In that case, he will not exert the same optimal effort as he would do under having the full marginal return. So therefore, the result is sharing results in inefficiency, in the sense that the amount of effort is done under sharing will be not as the one under having the full marginal cost. However, sharing are widely practiced, and economists have been puzzled about the existence of sharing contracts under such inefficiency argument. The literature here is vast and well surveyed, so I'm not going to go over it. So there are many benefits of having sharing contracts, despite of the inefficiency arguments. Here are some benefits that outweighs sometimes the cost of inefficiency. Risk sharing, reducing moral hazard under limited liability, reducing monitoring cost over inputs and outputs, and here are the references. Again, I have only 20 minutes, so, and I'm sure many of you are familiar with the literature, and it is well surveyed. So, our argument in this paper is to study the inefficiency argument again. So we got to redefine the inefficiency in a way that any effort that is deviating from the effort a self-financed entrepreneur would be an efficient one. So if you have the full capital with you, then there is no agency problem, nothing is there. You're going to exert the optimal effort in such a way that you're going to get the full marginal return. No external financing. This is the setup. So X is the amount of effort. CX is the disutility of effort. It is a convex function, as usual assumed in the literature. The project requires an investment of I. It generates a revenue of RS, where S is the state of nature. We're going to have only two states of nature, gain or loss, such that the probability of success is small p. The return under the gain state is greater than the investments, and the return under the loss state is less than the investments. We have the concavity of revenues. These are in dollar terms, by the way. And we have the third assumption is that marginal gain is better than the marginal cost, just to give the entrepreneur the incentive to undertake the project. This is the setup. So let's define these two variables. Gx is the gain in dollar term with probability of P. If the gain states is realized, Lx is the loss in dollar term too, with the probability of 1 minus p. Okay. Let's now work it out under self-financing. So this is the profit function of a self-financed entrepreneur. The optimal effort is this one, X start. And you can see by the equation, this is very familiar in terms of in the argument against the sharing contract. This one, we prove that lambda x is a fraction. And this sense, remember, this is self-financed entrepreneur. In this sense, self-financed entrepreneur is getting a fraction of the marginal return. This result is the backbone of the paper. So there is no sharing at all here, though we do have some inefficiency in the sense that entrepreneur is getting only a fraction of the marginal return. Okay, so self-financed entrepreneur gets a fraction of the marginal return while he bears the full marginal cost. This is the argument against the sharing arrangement, though we don't have any sharing over here. Now, let's study the external financing. Under sharing, the entrepreneur function will be this one. He will get a share of the gain and nothing in the loss states. He has this utility of effort. The optimal X will be the one that satisfies this condition. If we set the sharing ratio at this level, then the optimal X will be exactly the one that the self-financed entrepreneur is exerting. So by choosing the right sharing rule, we could have the entrepreneur under sharing to exert exactly the same level that he would do if he's fully self-financed. This is the problem of the entrepreneur. The financier problem is the following. He's going to get, in gain states, he's going to get a fraction of the profit. He's going to bearing the full cost of loss in the loss states. Subject to that the financier is getting that the gain he is getting is greater than mu, which is a parameter for the opportunity cost of the fund he is giving to the entrepreneur. X, now we have two cases here. If the constraint is not binding, then we would have this first order condition under which we find that the sharing rule is exactly the one that we had just found in the in the entrepreneur problem, and we have this result that if we choose this sharing rule, then self-financed effort will maximize both the profit, the profit of both financier and the entrepreneur. So by choosing the right sharing rule, we will be getting rid of the inefficiency problem in the sense that the entrepreneur will exert the same level as he would do if he is fully self-financed. So we will call this the alpha star. Now, if the constraint is binding, then we will give the financier the sharing rule that makes him satisfying the cost of fund, the opportunity cost. Then, using this relation, we find this alpha hat, the sharing rule, the other sharing rule that satisfies this relation. We insert this into the entrepreneur profit function to get this relation, maximizing this with respect to the effort. We get that we found that the maximum profit will be again at the at the effort of the self-financed entrepreneur would choose. We have also this result that the new sharing rule, if the financier constraint is binding, will be less than the sharing rule if the financier constraint is not binding. In summary, under the sharing arrangement, if the financier constraint is not binding, then we will have this sharing rule that would maximize both the financiers and the entrepreneur profit functions under the same effort a self-financed entrepreneur would exert. If the financier constraint is binding, then we will give the financier his opportunity cost, and we will be able to incentivize the entrepreneur to do the same effort as he would do if he is self-financed. Under debt arrangement, the entrepreneur will get this profit. In gain states, he has to pay only the interest payments. In loss state, he will have a bankruptcy cost, denoted by B here. We have also this utility of effort all the way around. The lender profit function is this one. He's going to get in the gain state, he's going to get only the interest payment. In the loss state, he's going to bearing the whole loss. There is no bankruptcy loss with the lender. Lender will choose the interest rate such that the gain he get, the expected gains he get is equal to the opportunity cost of the fund. Getting this relation inserted in the borrower equation, we find that the borrower, the entrepreneur, the borrower will have again X star, the effort a self-financed entrepreneur would exert will be the optimum. So in this case, debt will be also efficient. Now we want to compare both scenarios. We will do two comparisons. First one is the joint profit. Under sharing, the joint profit is this one. Under debt, the sharing profit is this one. If we compare both, we find that this one minus this one will be 1 minus the probability of success by the bankruptcy cost, which is positive. It follows that the joint profit under sharing is greater than the joint profit under debt arrangement. The reason is the existence of a bankruptcy cost. For the Pareto optimality, the proof of the results, by the way, are in the paper. They are long. I don't have time to go over them. This is the result 5 about the Pareto optimality of sharing contracts. So we have the sharing Pareto dominates debt as long as the profit, the profit the financier is getting minus the opportunity cost is less than the 1 minus probability of success by the bankruptcy cost. Just reading this equation, otherwise we will neither debt nor sharing Pareto dominate the other. Basically, we are saying there are some range where sharing would dominate debt, but there are no range at all where debt dominates sharing. Reading this equation, we see that if bankruptcy cost is high, then sharing will be better. If the probability of success is low, if the probability of success is high, we probably sharing optimality will be a bit less. If the financier opportunity cost is high, then he better go for sharing rather than go for debt. 5 minutes. Now. For information asymmetry, so far we haven't invoked anything about information asymmetry, and in the coming setup we invoke the information asymmetry aspects in the model. So we will have 4 possible states: high gain, high loss, low loss, just to make the entrepreneur able to misreport if he wants. we have this definition. We define net gain as the expected gain in the gain states, and net loss is the expected loss in the loss states. Again, we have the same assumptions. Under sharing, this is R hat is the announced net return. It's not necessarily is the same as the actual one. The entrepreneur might cheat, misreport the financier. RA is the actual return. Sure, actual return will be greater than or equal the reported one. If the entrepreneur misreport, then and audited, he will be punished by Y. These are the cases where misreporting can be seen. And the gain, if the gain is reported, this is the gray one is the gain. This is the investment. Above the investment will be a gain. If this one is reported and this is the actual, then this amount is the cheated gain. Under the loss, if loss is reported, there are two scenarios. The gain, there might be a gain or there might be a loss. In the gain scenario, if the entrepreneur is reporting a loss while there is a gain, then this is the amount of cheated gain. If the actual is loss, and the entrepreneur might report even greater loss than what he had, and this is the cheated gain. The optimal auditing in this case, so basically this situation is the following. The financier would say, okay, I will audit on your reported gain with a probability of phi, and because I know, as a financier, I know the maximum gain under the optimal effort, I will gauge my probability of auditing as a function of the difference, the distance between the reported gain from the highest possible gain under the optimal effort. In this case, this result, we found the optimal auditing likelihood. The idea is here just that the financier is trying to minimize the expected cost of auditing. If he is minimizing the expected cost of auditing, then these two are the optimal probability of audit probability. In this case, remember, this one is a function of the optimal effort under the gain under the optimal effort, which is known by both. In this case, now under sharing, the financier profit is this one. The entrepreneur profit is also this one. The idea is choosing the right sharing rule will again maximize both the profit of financier and the profit of the entrepreneur, in a sense that the entrepreneur will exert the same effort as he would do under the self-financing scheme. 2 minutes. In that situation, under information asymmetry, again, we will also be able to have the optimal effort will maximize both profits of the financier and the borrower's profits. Now, comparing both schemes, joint profit, we find that under sharing, the joint profit is greater than that under debt financing. This is the result 7. We prove that this is positive. Which says that under sharing, the joint profit is greater than the in sharing scenario, in sharing setting is greater than the joint profit under debt financing. For parity optimality, we found also again the under asymmetric information optimal sharing parity dominates debt as long as this equation holds. Otherwise, neither debt nor sharing parity dominates the other. This one's exactly the same as the one before under information symmetry. Expect that we have this term now here, which is the optimal audit probability, and this is the audit cost. This increases so this basically is saying that under information asymmetry, the range that sharing parity dominates debt is larger. Self-financing. Now we are trying to study the situation where the probability is endogenous, in terms that the effort will affect the probability of success and the probability of failure. In this case, self-financed entrepreneur get a fraction of the marginal return, which is this one. So again, he is a self-financed entrepreneur, though he gets only fraction of the marginal return. Under sharing situation, again, if we set sharing rule to this relation, we get that both will achieve their maximum profit at exactly the self-finance level of effort. So there is no loss of inefficiency, if you want. Under debt, which is interesting result, under debt setting under endogenous probability, the financier actually, the effort that maximizes the financier, the entrepreneur or the borrower profit is greater than exceeds the optimal effort of self-financed entrepreneur. So under debt situations where the probability of success is function of the effort, the entrepreneur will do more effort than he would do if he is self-financed under debt financing. Joint profit, again we find that under sharing the joint profit is greater than the joint profit under debt. And now there are two sources of inefficiency, if you want. The first one is the bankruptcy cost. The second one is the fact that the entrepreneur will exert more effort under debt setting than he would do under sharing schemes. Okay, so Pareto optimality, again, we get the same result, except now one more source. The range of Pareto optimality now is a bit larger because of the fact that under debt financing, the borrower would do more effort than a self-financed entrepreneur would do. With this relation, if this holds, we will have sharing Pareto dominate debt. Otherwise, no one neither debt nor sharing is Pareto dominate the others. So in conclusion, if we define inefficiency as the deviation from the self-financed effort, then we would be able to find that sharing could be as efficient as self-financing with the right choice of sharing rule. With bankruptcy cost, sharing could Pareto dominate debt, but not the reverse. With endogenous probability, something is missing here. Sharing is basically, this is the last result, and that's it for my presentation.
Thank you, Dr. And with your organizational skills, you've done an amazing job of going through 28 slides in 20 minutes.
Okay.
Thank you. Our presenter for this paper is Craig Lewis.
How's that? Okay. All right. So thanks a lot for inviting me to the conference. It's been interesting. I haven't spent a lot of time thinking about Islamic finance issues, so it's always nice to be able to explore something different and learn a little bit. So I'm going to discuss this paper, and I want to start out by noting that, if I can figure out how to make it work, overall, I think it's a really nice, clean theory paper, right? I think the model's effective, yet it's approachable. And I think one of the ways I looked at this model is if you wanted to make key points, this is about as parsimonious a treatment as you could find and demonstrate those points. So you saw a lot of math, but it's really not that difficult to go through because the paper's actually quite well written, right? So it flows, it's easy to read. I think my view is that the main contribution of the paper is that it provides a framework for evaluating the efficiency of sharing contracts relative to straight debt. And what it's going to do is it's going to show that an appropriately designed sharing arrangement will be able to achieve first best outcomes that would be available to a self-financed firm. Right? Now, the way I tried to look at the paper itself was I tried to take a step back and look at it more from a US-centric perspective. And this is a paper that's essentially saying, how do you want to finance a project? How do you want to finance a firm? And so when I think of capital structure theory, I think about three basic types of theoretical arguments that are made in the literature. You can think of a tax trade-off theory, right? This paper has elements of that. You can think of asymmetric information. I think this paper has elements of that. And you can think about agency cost explanations. And this paper really does not talk about agency, but I actually believe that's probably the more fertile ground for thinking about how to extend the paper as you go forward. I initially found some of the results in the paper almost followed directly from the way it's modeled, right? And the idea that a sharing arrangement is going to dominate debt financing, for example, seems obvious when there's a deadweight cost associated with bankruptcy. And when I initially thought about this, I thought, well, when I teach capital structure theory in my classes, we always talk about in the US how you're trading off the tax benefits of debt financing and the interest deductibility of those against bankruptcy costs. And so I'm thinking, why would this not possibly lead to debt dominating a contract that looks more equity-like? Well, the explanation is really one that's rooted more in the institutional details of what we're looking at when we think about Islamic finance, and that's because interest is not tax deductible. So there really isn't a benefit from a debt-like claim in the way we think about it in the US, and there really is nothing but a pure deadweight loss. So one of the things I would probably do is try to emphasize more of some of the institutional details so that people get a better appreciation for why this is actually a very reasonable way to actually model it in this particular context. Asymmetric information is a little bit different. Basically, the asymmetric information stories that you're used to in corporate finance relate to basically information sensitivity of different claims. And when there's adverse selection, you can imagine that a firm will there's sort of a pecking order idea, right? That you will issue claims, basically issue cash, you'd issue debt, and then you go to equity. And largely because that debt claims are less information sensitive because of the fixed nature of the promised payments than equity. And so there's less adverse selection associated with sort of a debt issue. Well, this is really about unobservable action on the part of manager, and the asymmetric information that arises in the paper is really unobservable action. It's more of a moral hazard explanation for sort of asymmetric information. So as we go through here, here's the basic paper, and this is a simple sharing contract that the entrepreneur puts together. So the first line, if you want to think about how the paper is motivating us to results, it says, we're basically going to just maximize profit subject to an effort sort of penalty or an effort cost. So it's a simple optimization. And then if we're going to put this into the context of a sharing contract, then what happens in this context is that the entrepreneur retains a share of those profits, but is still paying the full cost associated with personal effort. And then the financier is going to take a share, the offsetting share of the profits, but will bear the full losses associated with that. And the key here is that by basically going through the optimization problem, you can find an alpha, if you will, or a sharing contract that will allow the sharing contract to achieve the first best optimum under the standalone self-financing contract. And that's sort of the benefit of this approach, right? And so when I thought about this, the way this looks to me is this and the prior paper, when you think about what the sharing contract really is, it's really just a warrant, if you want to think about this, on the underlying firm, because you're basically, if you think of standard equity, when you get equity, if the value of the underlying firm goes up and that equity option's in the money, you're participating 1-for-1 in the benefits of the firm. In a sharing contract, you're really not participating 1-for-1, you're participating at the sharing ratio. So from a pricing standpoint, if you want to take it beyond this model, this is just Black-Scholes type prices that I put together, but price this as a warrant. And then a lot of what goes on in this is actually sounds a lot like some of the discussions that Eric had yesterday, and that from the perspective of the entrepreneur, they're holding essentially a warrant on the underlying firm. The financier is basically holding something that looks a lot like convertible preferred stock to me. Now, so the warrant claim is basically a convex claim, right? It's convex payout. The convertible preferred stock is a concave payout. And this sort of leads to a situation where you think about, this is why I thought it could be really productive to think about sort of the agency-based explanations, is because you have these risk-shifting opportunities. And this seems to be something that looks a lot like the model that's used in the US for venture funding. And basically, you have this problem that, as Eric pointed out from the point of the financier yesterday, the risk-shifting problem is to shift into low-risk projects. We'll turn it on the other side of it and look at it from the perspective of the entrepreneur, and they want to risk-shift into higher-risk projects. So from that perspective, and so what I did was these are just two different graphs, one with a sharing ratio of 25% and the other with a sharing ratio of 50%. And to give you a sense for just how the contracts change as the ratio changes. Now, oops. All right. I think I can deal with this. So now, where does the paper go next? Basically, the paper introduces bankruptcy, as we talked about. I guess it's no surprise that if you impose a dead weight cost, it's going to be less efficient to use debt financing, right? And then the next one is to look at bankruptcy and unobservable actions. And in this case, all right, I'll just deal with this. So the unobservable actions basically lead to a situation where debt's still dominated. So basically the idea that we have asymmetric information doesn't really change the lesson that's coming out of the modeling exercise, and that is that these sharing contracts dominate straight debt in this framework. All right, now I'm going to just offer a few things I thought might be useful, and the one thing that I thought were possible extensions and how I might consider modeling this. And the first thing is that debt is a deadweight cost. It's treated as a constant in the model. I really thought that debt is probably a function of the underlying amount of investment, right? So when I teach a corporate finance, we don't say bankruptcy costs are constant. We say it's a function of the value of the underlying firm. So if you think about this, it's convenient to have debt as a constant because it really doesn't affect the first order conditions in the optimization. But I think in a more sort of general model, you want to have something like that there. The other thing is I think it would be nice to see an extension that looked at agency costs. And one of the ways I thought you could do this is to really think hard about not only just having a profit sharing ratio, but more in the spirit of what we saw in the previous paper to also incorporate a loss sharing ratio as well. And I thought if you had the loss sharing ratio embedded in this as well, it really gives you an opportunity to think about how to deal with risk shifting problems, because when you incorporate a loss, basically this is how the optimization problem changes. But I'm just going to go quickly to a graph, right, and sort of to make the point. And the point that I want to make is when you have both a profit ratio and a loss ratio, you basically you can linearize the payoff to a certain extent. So when you introduce a loss sharing ratio, instead of just having a purely convex claim, what you're doing is you're essentially linearizing this payoff, because with a loss ratio, you have not only a warrant that you bought or that you hold if you're the entrepreneur, but you've sold a warrant as well. And so by having the long position in one warrant and a short position in the other warrant, you effectively can sort of take that convex claim and linearize it. And the same incentive effect is going to be realized on the part of the financier because it will also linearize the payoff. And so in this graph you can see is what I've done is I've basically gone from a situation where this was the original setup where there was no loss sharing ratio. And what you can see is that this is the warrant claim. You can see that the financier is basically taking everything up until the point where there's actually a profit. And then this is how you get the concavity in the convertible preferred piece. Now as we introduce a loss sharing ratio, what you'll see is that now the entrepreneur is actually absorbing some of the loss, which means that the financier is doing okay. And you'll notice that this claim, it's hard to see here, but this claim is much less concave and the convexity in this claim has been reduced. And if you go to a point where the sharing ratios are exactly the same, you basically have quasi-linear, these are effectively linear contracts and linear payoffs. So that sharing ratio on the loss side gives you the ability to really to take away or try to ameliorate some of those moral hazard issues. That'd probably be the way I would go with this if I could. So let's see what I had here. One of the conjectures I thought is that maybe the optimal contract? One way to think about this is the optimal contract one where the profit and loss sharing ratio are actually the same. And I'm not sure if that has a precedent in Sharia law, but I think there's something to that, right? And so that was basically, now as far as some other ideas I had, I'd like to say a simple numerical example. I worked something out with a Cobb-Douglas production function. It's pretty easy to do the optimization even in the two-state case, so it would be helpful. And one of the things that I thought when I read your paper, but I also listened to the other authors, is I'd like to know a lot more about some of the stylized institutional facts around this market. Like, what is the sharing ratios that companies typically agree on? Is it 2%, 50%, 90%? I want to know how big these numbers are so I can get a sense of how, what's really going on with the contracts. I think it would be helpful. This doesn't have to be an empirical paper, but it would be nice to have some type of stylized facts to go along with what you're saying. There's normative statements in the paper about.
Oh, sorry.
This is the disco part of my presentation. And so you made some normative statements about the value of random audits. I've never heard of a random audit before, and so I'm thinking about more of this from a company that's publicly traded in the U.S. There's an audit requirement in the U.S. I don't know if Islamic, finance requires annual audits when these things are publicly traded, but I think that's kind of a throwaway comment, and really, I don't know that section adds a lot to the paper, to be perfectly honest. It's just you, but I could live without it, right, if I was going there. And then the other thing is just really more discussion about, if you want to reach a broader audience, more discussion about the underlying institutional features and how they really affected some of the modeling choices, which are quite natural once you learn a little more. All right, so that's what I had.
Thank you. Very quick comments, responses. We were running late, so I'm going to move on to the next paper if you don't have anything. So our last paper is on profit sharing, wisdom of the crowd, and the theory of the firm. And our presenter is Jocelyn Lee.
All right, thank you for inviting me to the conference. I've learned a lot over the past one day. So as the title of the paper suggests, we are talking about profit sharing, wisdom of the crowd. So the idea is that how can we design an optimal profit sharing rule so that the sharing rule can harness the collective wisdom of all the signing parties of that particular rule. And given that result, I'm going to show that how is the profit sharing rule related to how can we think about the optimal structure of firms. So in the paper, actually, I will have a session discussing what's the relationship between the firms and the markets when I model the market under a noisy rational expectation framework. Given the time limit that there's zero probability I'll be able to get there at that point. But so what I'm going to do today is just like to give you the simplest version of my model so that to illustrate the points that I want to make. Okay. So just to kind of illustrate, to motivate the paper to fit in the structure of Islamic finance, we can think about a partnership structure like a musharaka. In musharaka, basically, the partnership structure is that each investor will receive a pre-agreed portion of the profit or loss. And this has been extensively used as a substitute for conventional banking. And one particular feature of this partnership structure is that it's very flexible because the sharing rule can be arbitrarily designed. Then the question is that what is the optimal profit sharing rule? And the question in certain sense seems to a little bit redundant because conventionally, for example, in the US stock market, right, how we design profit sharing contract is that every partner, they put in their initial investment. And based on their initial investment, they'll decide on what the profit sharing rule would be. If I invest more, then I will be entitled to more of the total profits. If I invest less, I'll be entitled to less. Then what does a sharing rule really do to actually to overcome what we can see here? A important assumption in this, in my paper, is that I would assume that there's a so-called wisdom of the crowd. Or in other words, that a group's collective wisdom often dominates the opinion of any single individual. This is, how applicable this assumption is empirically is of course a question, but in the literature there seems to be a lot of extensive discussions using the wisdom of the crowd. Even when we go back to Hayek, who argues that decentralized information seems to be an important feature of the economy systems. And also that if you think about this literature on studying financial markets, like Hellwig, 1980, or Diamond Verrecchia, they also assume that there's dispersed private information in the financial market. And what we are going to see today is that how this similar feature can be used for us to study the market. Study the firm rather than the market. So, as I said, I'm just going to give you the simplest model that we can think of. So here it is. Let's assume that there is a scalable investment project and assume that the return of this project for each dollar invested is given by a random variable, R tilde. And let's assume that there are two identical, deep-pocketed, and risk-averse investors that are interested in investing in this particular business. Let's assume that the two investors is Bill and I, okay? And for simplicity, for the moment, let's just assume that both Bill and I have a risk aversion, which is captured by exponential utility function. And for simplicity, for the moment, let's just assume that we have the same risk aversion parameter. Okay? And that idea of wisdom of the crowd comes to the fact that both Bill and I have unbiased private signals about what the return of the project is going to be. So mathematically, then it just looks like that each of us have a private signal which equals to the true realization of the R tilde plus some idiosyncratic noise. And this idiosyncratic noise follows normal distribution. They are independent. Okay. And another assumption is that because the signal is independent, so if I can magically know what Bill knows about the R tilde, then I would like to combine his signal and my signal to update my posterior so that I can make more informed investment decisions. But the assumption is that here communication is costly so that we cannot actually communicate our private signals. So what I'm going to try to do is to see whether we can design a profit sharing contract such that under this contract, it changes our investment incentives in a way that even though we do not communicate our private information, but we will invest in a way such that our final payoff would look like as if we fully communicated our private information. And if that it can be achievable, then it's kind of a free lunch, because when a lot of investors come together, it's very costly for them to communicate their private information. But if they don't communicate at all, but just with that particular contract, then they can achieve the effect of wisdom of the crowd. That would be kind of a fantastic thing to do. And I'm going to show you that under the setup here, actually the profit sharing contract looks very, very simple. So it's very easy to implement. Okay? And in particular, in this example, I'm going to show a somewhat counterintuitive result, that no matter how precise our private information is, the optimal sharing rule between Bill and I is always to go 50-50, as long as we have the same risk aversion parameter. So I want to give you kind of a numerical example to see what do I mean by profit sharing. In particular, what do I mean by 50-50 profit sharing? And how is it different from the conventional, the traditional like equity contracts in which the sharing rule is contingent on the amount of initial investment? So think about that. Based on his private information and his risk preference, Bill found that it's optimal for him to invest $200 in a particular scalable project. And based on my information, I'm less optimistic, or I'm just like, and based on my private information and based on my risk aversion, I found that it's optimal for me to invest $100 into this particular business. Then, under a typical equity contract, because Bill invests $200, I invest $100, he will be entitled to 2/3 of the total revenue or payoff of the project. So if the project goes up by 10% in the next period, because our total investment is $300, if it goes up by 10%, then the total payoff is going to be $330. And Bill will get back $220, and I will get back $110. And that's what a typical equity contract we usually observe. Now let's look at what do I mean by 50-50 profit sharing contract. Still, assume that Bill still invests $200 and I invest $100. The net profit, if the project goes up by 10% in the next period, is going to be $30. And by profit sharing, I mean that equally sharing that net profit. So in the next period, Bill will get back $215 and I will get back $115. So on face value, you might look at, well, this sounds like a pretty bad deal for Bill, because under a net typical equity contract, he can get back $220. But now he only gets back $215. Under what circumstances would he ever want to agree to this 50-50 profit sharing rule? But the key in this thought experiment is that having a profit sharing contract overhang is actually going to change our investment incentives. And so in certain sense, having a 50-50 sharing rule will make Bill entitled to a smaller piece of a larger pie, which I'm going to show you mathematically in a couple of slides. So just to give you another illustration, right? If Bill invests $200, I invest $100, and let's compare what's going to look like in a typical equity contract and under a 50-50 profit sharing rule. If the project goes up by 10% in the next period, under a typical equity contract, the sharing rule is going to be proportional to our initial investment. So Bill will get back $220 and I get back $110. Under a 50-50 sharing rule, he gets back $215 and I get back $115. And we notice that the 50-50 sharing only applies to the profit part, not applies to our initial investment part. And that's going to be very important. So, but still, if that's the end of the story, then it's still a bad deal for Bill. But as I said, it changes our investment incentives. Because having a profit sharing rule overhang, it is kind of like an insurance that insures against the noise in our investment, our private information. When I have my private information, well, and I think, well, but I know that it's kind of a noisy signal, then my risk aversion is actually going to prevent me from taking risk. And then having a sharing rule with another person makes me feel that, well, actually, I can be a little bit more aggressive because any mistake that I make actually is going to be, in certain sense, be hedged. And you can, in a certain sense, you can kind of frame this as a moral hazard. You have an insurance and you have moral hazard. You take on more risk. But here, the more risk that you take actually is a good thing. Because by taking risk, it means that we are using our information more efficiently. So under the assumption that if private information is dispersed among participants, having a sharing rule actually can make can in general, in aggregate, make us invest more informedly. So I'm going to give you a kind of a theoretical, mathematical, rigorous proof of the arguments that I have made so far. So the exercise that I'm going to do is to consider 3 cases. The first case is to kind of investigate what is the optimal investment strategy if we are organized under a typical equity contract, traditional equity contract. The second case I'm going to think is that what if we are still having a typical equity contract, but instead we can communicate our private information prior to making our investment choices? What's going to be the optimal investment rule? And the third case that I'm going to think about is that what if we have a 50-50 profit sharing rule, but there is no communication of private information? And what I'm going to prove is that under the second case, in which we have perfect information communication, and in the third case, in which we don't have perfect information communication, but we have a 50-50 profit sharing rule, the final payoff to both Bill and I would look exactly the same under these 2 cases. So in this sense, a 50-50 profit sharing rule serves as a perfect information aggregator because it harnesses the collective wisdom of the signing parties, even though there is no actual information communication. So this is the first case. So from my perspective, if I have an exponential utility function, and then I just basically, my investment choice is to decide on how much to invest to maximize my expected utility. And the expectation is taken over the risky return, R tilde, and it's conditional on my own private information. And this is a very familiar current normal setup, and we can immediately show that the optimal investment strategy function is going to be a linear combination of the unbiased mean of R tilde and my private signal. Okay? So if my private signal is higher, I'm going to invest more aggressively. Or if my private information is more precise, I'm also going to invest more aggressively. Okay. So the second case is that if we can perfectly communicate our private information, then mathematically the exercise is very similar. We still will have that the optimal investment strategy function is going to be a linear combination of the unbiased mean and both private signals, because in this case we have fully communicated our private information. The interesting case comes to the third case, in which that what if there is a kind of 50-50 profit sharing rule? When we have a 50-50 profit sharing rule, from my perspective, I still want to maximize my expected utility. But when I calculate my expected utility, I know that some of the payoff is going to be determined by what Bill does. And that's a function of his private information, which is not known to me. So then I have to form a belief of what Bill thinks based on my own private information. So the solution will look like a Nash equilibrium. So the definition of this Nash equilibrium then would be that given the correct belief of what the other investor is going to do, given each private information, that I myself is going to choose the optimal investment amount. So if we calculate if we try to calculate the Nash equilibrium, then I can, under this case, I can just use a guess and verify approach. I assume that, I conjecture that my investment strategy function is an affine function of the private signal that I have. Then I just plug in the definition of the Nash equilibrium and use a method of undetermined coefficient. And if we calculate the expected utility under this case, basically what the maximization problem that we'll be having is to maximize the expectation of the exponential function of the product of two normal variables. So it looks very like a moment generating function of a chi-square distributed random variable. And if we do the math, we can show exactly that the profit sharing rule would look like this. So if we look into the structure of the optimal investment strategy function, under the no profit sharing rule, as we have illustrated before, it is a linear combination of unbiased mean and my private signal. If we look into the optimal investment strategy function under a profit sharing, 50-50 profit sharing rule, then it still is going to be a linear combination of the unbiased mean and my private signal, except that there's going to be a 2 in front of the coefficient of the private signal. So that's what I mean that actually having a 50-50 profit sharing rule will make us invest more aggressively. So actually, every partner under this contract will be entitled to a smaller slice of a larger pie. And the fact that we invest more aggressively also kind of illustrates the point that I made earlier, is that having a 50-50 sharing rule looks like an insurance contract that insures against whatever noise that we have in our own private information, so that we are willing to take on more risks. So I think, like, for example, in the keynote speech by Franklin yesterday talked about that, well, look at Europe and the US, and the US seems to be why US thrives, seems to be that the US is more likely to take on more risks. But in this case, having a 50-50 sharing rule also incentivizes individuals to take on more risk, and which is a good thing. And okay, and also we have to look at the information, the full information benchmark earlier. If you look into the sum of the investment amount under a 50-50 profit sharing rule and under a full information benchmark, what we will find that when they add up, they look exactly the same. So it is kind of the theorem that under all realization of the state of nature, each investor's payoff under an equal division of profits is always going to be equal to a full information benchmark. So this just illustrates the point of how does a profit sharing contract look like a typical partnership firm. Because in a typical partnership firm, people first come together, they decide on the rule to divide the residual earnings. And then with that sharing rule in mind, they work for that particular business. And however, how much time they work usually are billed. And so that it means that kind of like their initial investment is paid out first. And whatever remains is going to be divided according to a rule which is determined in the first period. So this is what I mean by theory of the firm from this very simple example. And of course, I can kind of extend this model in cases which, like, there are multiple investors, they don't necessarily have the same risk aversion, and it also works. So the conclusion is that under the setup that I have so far, some simple profit sharing rule can actually achieve first best effect in terms of, like, harnessing the collective wisdom of all its signing parties. And of course, there are a lot of caveats, right? Because I'm here kind of assuming away limited liability. I'm assuming away wealth effects, but because I assume all the investors have a constant absolute risk aversion utility function. And also, I rely on the fact that there is wisdom of the crowd in the economic system that we're analyzing. Sometimes it might not be true because individuals might be overconfident and they actually believe that they are the smartest and they don't want to partner with others. But the punchline is that if we look into the most standard assumptions that we can find in information economics, it seems that a very simple profit-sharing contract achieves some somewhat surprising but optimal sharing rule. So I think the implications for business organization, security design, and musharaka, I will leave that to open discussions after the talk. And thanks.
And our discussant for this last paper is Jared Harper.
Okay. First, I want to take this opportunity to thank the organizers and our hosts from KFUPM. This has been really fantastic time. The hospitality has been tremendous, and the discussion's been really interesting. I've learned a lot during my stay here. So I have the pleasure of discussing this paper, and as you know, it was awarded the best PhD student paper last night. So that makes my job difficult because you already know it's a great paper. So I will focus my comments on more high level, some of the things I thought about as I was reading through the paper, some things that I think it could be extended to. I think there's a lot that Jason could do with the mechanisms that he's developed here, and so I'll focus on that. Okay, so Jason did a fantastic job summarizing the paper in a very accessible way, so I'm not going to spend a lot of time on the usual summary. I'll just say that the basic idea here is that people have different signals about the value of an endeavor. It's decentralized information, heterogeneous preferences. His example, they had sort of the same risk preferences, but the model can definitely handle heterogeneous preferences. And we'd like to be able to benefit from the wisdom of the crowd, right? This is sort of a well-known issue in economics. There's a great book about the wisdom of the crowd. But we need a way to aggregate this information, and there needs to be an incentive to contribute your piece of information, your independent signal. We want to shut down any lying. We want everybody to contribute their signal honestly. And everyone's action depends on what they think everybody else is going to do. This is a classic coordination problem in the wisdom of the crowd context. So it's one of it kind of double clicks here. Okay, so what happens in this paper? He shows that a simple profit sharing contract can solve the problem. He allows for information aggregation, so each agent behaves as if he would if he had the full set of information. That's what he was talking about, when if we had perfect communication, we'd all have the full set of information, and he shows that under his profit-sharing contract, we end up with the same paths, we behave the same. It's incentive compatible, there's no lying about your signal. It only requires that we all have information about everybody's preferences, their risk preferences. And he shows that it works well in a wide variety of settings. He only got to talk about a few things in his 20 minutes. Wow, this is the same problem Craig ran into. Okay, so a couple points that Jason talks about here. What about markets, right? Isn't that the whole point of markets, to aggregate information using prices? He says, well, yeah, that's true, but there's lots of settings where markets are incomplete. And he even talks about how this kind of setting is going to, this kind of profit-sharing contract will arise endogenously to complete markets in those settings, such as funding startup businesses and so forth. And we see profit-sharing agreements in many settings in different economic systems. In the paper, he mentioned specifically Mudaraba. In his talk, he talked more about Musharaka, and so I'll mention both of those in my talk. And then he, my overall comments about the paper is that I thought it was a very interesting exercise to show why to step back and say, why have we seen profit-sharing agreements arise? Can we make them endogenously arise in a setting where we need to aggregate information? And then he points to some really interesting extensions, such as theory of the firm issues, as well as understanding new types of funding, such as crowdfunding. So a couple things that I was thinking about as I read through the paper. So first of all, and he kind of hinted at this in his own talk, right? How much of this is actually coming from a risk-sharing channel versus a profit-sharing channel, and I think that's worth exploring more. In the paper he talks about, and he mentioned in the talk, everybody responds more aggressively to their own signal, and he talks about parallels to diversification. We know that profit-sharing and risk-sharing are important tenets of Islamic finance. And I think it's interesting, there's some potential interesting extensions here of the model that you've written down, because there are different ways of handling these using different contracts, at least in my very limited, admittedly, understanding of Islamic finance. In Midaraba, there's no financial loss sharing, right? There's a financial partner and there's the entrepreneur, and they have profit sharing, but the financial partner bears all of the financial loss, and the entrepreneur has a potential for loss, but the loss is that his effort actually just comes to nothing. So I wonder if there's a way to kind of incorporate that setting into your model as well. In Mishraka, there's both profit and loss sharing, right? And that was what the most of the talk was based on, but in my understanding, these don't have to be symmetric in the sense that the profit sharing rule has to be predetermined, and it can be anything, and that's an important part in his models, that we can agree on any profit sharing rule ahead of time, and it doesn't have to be in proportion, it doesn't have to be based on the precision of our signals or the proportion of how much money we put in, but the loss sharing under Musharaka that I've seen is in proportion to the capital provided. And so you actually have an asymmetric profit and loss sharing, and it'd be really interesting to see if you can get that to fall out of a modified version of your model as well, because I think you've come a long way toward showing how this stuff endogenously arises. And there it goes again. I almost feel like I should just use the button instead. But I'm going to get a feedback. Okay, a few extra comments about the model. It appears that it's important, if not critical, that all parties are simultaneously contracting, because you need to see what contract people are willing to accept in order to extract their information. So that seems to be critical in the model. One thing, the only thing that nobody can lie about or nobody has any incentive to lie about their signal. But the profit sharing rule depends on the risk aversion. So just a thought that crossed my mind as I was reading is, can I and would I lie about my risk aversion? But we see a lot of settings in real contracting and real financing where there's sequential actions, right? So in venture financing, there might be early investors that essentially certify the potential of the idea, and so we don't have everybody bargaining at once, and you don't get this. I don't think you get the same effect you get in his model. And we know that one of the classic problems in the wisdom of the crowds is to prevent an informational cascade based on early movers with bad information. And so the question of whether you could incorporate sequential actions and yet still avoid informational cascades would be really interesting to me, especially because under these situations you might have incentives of later participants to free ride off of the early information discovery. Some of the extensions that he mentions and that I'd like to talk about as well, he talks about crowdfunding. And so I think the question arises, do you need profit sharing to induce the wisdom of the crowd and crowdfunding? I think so, because usually you either need a prize that everybody is trying to win to get the wisdom of the crowd, or you need profit sharing. But again, in crowdfunding, I think you have this real potential problem because typically the way this works is you sort of see the people beginning to sign up for the project, and so you have a real potential for an informational cascade. So I think more discussion of how to avoid informational cascades would be nice here. And then the modern theory of the firm he touches on, right, and how profit sharing agreements can help in this context, because the old theory of the firm depended on having access to physical capital that you could then deny other people access to that physical capital. And so we focused a lot in the modern theory of the firm on what's the glue, right, that keeps these information-driven, intangible firms together. And it's not clear, at least in what I read of the paper, what keeps one agent from absconding from the idea once the contract aggregates the information. I have the aggregated piece of information, and now I just leave and do it on my own. And then applications to venture capital funding, right? So we often see that VCs expend resources to make their signals more precise, but in his model, the profit sharing is based strictly on preferences, not on the precision of my signal. Can you extend the model to explain how later rounds typically get smaller shares in the sharing rule? And again, this would be an extension to sequential investing. How do we think about an IPO in the context of your model? Are we just writing a new profit sharing contract with the new investors effectively, and the price is aggregating their information? But overall, as I'm out of time here, I really enjoyed reading the paper and thinking about this issue of inducing wisdom of the crowd in incomplete market settings. There are lots of interesting extensions. And as you saw from some of my comments, I'm just going to encourage him to take the machinery that he's developed here and apply it in more settings. I think that would be really interesting. So thanks for the opportunity to read the paper and give my discussion.
We're way out of time, so please join me thanking all the presenters and discussants.
We'll come 11:15, okay? We will come 11:15. We have a break now. We'll come.
Okay, so we will still have our coffee break, maybe a shorter one, and then we'll come back for the next session in
11:15.
11:15. Okay.
Hello. Hello.
You have something to do?
It's okay now.
Yeah, it's working.
You need this or the old one is working?
Old one is working, yeah. Yeah. Alaikum salam. How are you, Doctor?
I disturb you.
Yes.
I have to ask if this participation is bad like this one.
Participation?
No, this participation.
Oh, this.
Yeah, because I am here from yesterday evening, but
When you enter the symposium, you see there are some people on the right-hand side sitting. That's the registration area.
but nobody was.
No, I saw them. I mean, when you go straight in, straight up, on the left-hand side. It's been straight. Actually, I don't want to risk it, so this is a better place. Better there it is. Okay. This session. Did you put it in this other folder? Fourth? Yeah. Just name it by your name. Great. Thanks a lot.
Sure.
Enjoy. enjoy the break? I hope you are enjoying already.
Oh, yes. I got my water.
Go ahead, sir.
What time are we starting the next session?
11:15. We have.
Because I thought we had a 15-minute coffee break, and now it's
Yeah.
25.
We're sort of behind time, and for some reason they extended it, so
Okay.
it's up till 11:15. Okay. All right, doctor.
This is fourth, right? I think we probably we had it in the third. Can we check third? We made multiple mistakes. No. The desktop, probably date. I don't know. So this is
Yeah, no,
fourth.
I checked all these.
Cook determined corporate for calendar Kabir Hassan Adamson. Let's have it again one more time. Please.
Okay. Can you
just
specify the file?
yes, let me just find out. Put it to desktop here.
In this folder.
Here.
Yeah. Okay. Then just leave it now.
Hold on. Where is it? This one. Okay.
I will rename it. Just if you just give me a second.
Can I pick it up?
Sure, you can take it out. Yeah. The name is Piety Politics. Huh? It's actually this is the most attractive name I've seen in all of these papers. Piety Politics and religion.
And portfolio selection. It's a simple idea.
Okay.
Can
Anyway. Yeah, if you want to just make sure it's fine.
Perfect. Yeah.
This is the one, right?
Yes.
Okay.
Possible I can get a copy of these sections also.
Copy of what?
Copy of the paper, the slides.
All of them?
Yeah. So let's do this.
Okay, there is one misnamed, but I'll just
You
put
can no, don't do it. Just put the folder. That might be easier.
Okay. Day2. I'll just put this one, all of it, right?
Okay.
This is Day2.
Perfect. Because it's much
Okay.
easier to look at the slides than the papers.
Okay.
sharing now, so we're going to take care of this, right?
Yeah, pretty much.
Okay, as they move.
You had this the last session. Oh, next one. Yes, sir.
11:14.
What is it?
Make sure this one doesn't make any noise. خلاص هو ready يعني دقيقتين
Assalamu alaikum. Bismillahirrahmanirrahim. This session on sukuk, we have 3 papers. First paper on how sukuk shape firm performance. And I guess our presenter is Professor Paul Klein from Strasbourg University in France. Please, Professor Klein.
All right, so hello everyone. My name is Paul Klein. I will present a paper written with Laurent Weil and Christophe Godleski from University of Strasbourg. University of Strasbourg is still in France. And this paper is studying the sukuk market and tries to answer a very important question: is does the sukuk impact differently the issuer than conventional bonds would? That's the idea. So what the motivation investigating sukuk apart the fact coming to such great events? It's the idea that sukuk represent 14.6% of Islamic finance assets, and more importantly, it's the only big security Islamic finance use to fund projects, investment projects. If you look to what sukuk are, sukuk is a plural in Arabic. If you look to what sukuk are, it's an alternative mode of financing to bonds. Because like bonds, it has coupons, it has a maturity date, and it has a refunding value. But what matters is to underline that unlike bonds, it has great differences. Because sukuk shares represent the ownership of a tangible assets or usufruct or any services of revenue-generating issuers. So there are similarities with bonds, but there are also lots of differences. And what matters is to study the impact of these differences, because so far it has been largely eluded by both practitioners and academics. If you go to Bloomberg and just type bonds, or if you go to the search function, if you know it, you will have sukuk 2 as you will have bonds. If you go to the Security Commission of Malaysia, you have the same section for sukuk and bond. Why everyone is thinking sukuk are like bonds? Maybe there are huge differences. There are huge differences in structure. And these differences may impact the value of the issuers. So as I said, few papers investigated the differences. And I have some here, but maybe there are more. Sorry if I forgot some very important paper. But if you look to sukuk's risk, you have this paper for Ian Stuckey in 2007 using a value at risk approach. If you look to the stock market reaction and looking if the stock market reaction is different between both investors, you have this paper from my co-authors, so Godleski and Weil, and Turkaris from the IMF. And they show that there is different reaction on the stock market for both instruments. Now, the aim of this paper is to further dig the impacts of sukuks on the issuer. And the questions are, is there any impact of the issuer's profitability? And what are the differences with bonds? And is there any impact on the issuer's long-run stock returns? Two ways to measure profitability, if you want. But first, let's have a very quick overview of what sukuk are. If you want if a firm need to raise funds to invest and select sukuk, what a firm will do. First, the firm will sell the investment assets. So the firm sells assets. The firm takes some asset from its balance sheet and put it out. It sells the asset to a special purpose vehicle out of the company. This SPV buys the assets using raising money from investors, and they pay regular coupons coming from the assets. And at the end, the firm buys back the assets to the SPV, and the SPV will fund investors. So the aim is to look like a bond, but it's not a bond. If you take an Israel sukuk, it's much more complex than a bond. I will not try to explain detail this graphic because actually it's very, very simple. It's a sale and leaseback structure. The originator sells the asset to the SPV. The SPV raises money from the investors, and the SPV leases back the asset to the originator who pay rents, and these rents are used to pay coupons and so on. So you just put an SPV between these both. With the bonds, you have a direct link. With a sukuk, you have an indirect link. So you already see that there will be huge differences stemming from that specific structuration. Our main hypothesis is that the impact for the issuers is negative. And here are the reasons. So why? Because you have legwork costs. You have the cost of structuring this SPV. You have the cost of having lawyers. You also have bankruptcy costs, higher bankruptcy costs. Why? Because the ownerships of the assets or the usufructs are not clear at all. And if you look at this paper from Winsberg and Zaire, they show that in case of default, the sukuk asset's property is not clearly defined. And this generates very huge costs for both the issuer and the investors. You have agency costs stemming from moral hazard of the management, because the management will manage the project with generating the stream of cash flow, but will not endorse the responsibility in case of default. So you have a moral hazard structure, very easily understanding, and you may have an adverse selection impact. Why? Because the issuer may be tempted to put the less performing assets and less performing projects outside the balance sheet. So, and last, you may have what Jensen doesn't like. You may have a retention of free cash flow. Why? Because the issuer is no more have a non-contingent contract. It does not have to pay cash flow in either state of the world. If the structure is not performing well, it does not have to pay cash flows. So you may have a retention of free cash flow, and Jensen showed that it could be very detrimental to the firm performance. Okay, that's the reasons. How will we measure firm performance? It can be very difficult, and we may have a lot of proxies. You can imagine a lot, actually. We will not remake the standard theory of the firm or standard corporate theory. So we're just looking to the EBITDA and the return on assets. EBITDA for the core performance, a return on asset for the global performance of the company. And from stock performance, we're looking to long-run stock performances. Okay. It's an empirical study. Again. Try to stop that. Battery should be a bit low. We compare bond and sukuk issues, and we compare the performances after the issue using balance sheets and stock returns. We use the Malaysian debt market of debt issuances, both bonds and sukuk. Why Malaysia? Because Malaysia issues 80% of the sukuk worldwide, and more important, it has a big bond market in standard of corporate emerging countries, It is the second deepest bond market in the world, in the emerging world, if you want. We look to 164 sukuk issues and more bond issues, of course, from 2002 to 2010, and we use only single issuers because we are looking to very long windows, up to 5 years. Sorry. Okay. So here is the sample. You can see that sukuk issuance are much more lower, but a bit increasing after 2004 due to Security Commission of Malaysia efforts to promote Islamic finance. Here is a rapid overview, a quick overview of the sample. You have some differences, but just to show that it has an issue price, a coupon, maturity too. So for Bloomberg, it's just like bonds. No differences. But there are differences. What we know is that, we only know that actually, if you want. We know that sukuk issue generates a negative stock reaction. And if you look to bond, you have positive stock reactions, these cumulative abnormal returns, and for sukuk, you have negative stock market reactions. So this is a result of God bless it took unveiled from the GCE, sorry for the acronym. And we know that stock market investors react negatively to a Sukuk issue. What we do not know is why. And we know that they expect a decrease in firm value. That is new information coming in the market. So something is happening, but nobody knows really why they would react differently if it's just a bond. So maybe it's not just a bond. Okay. So does a decrease in the firm value happen? And this decrease, can it explain the first reaction of shareholders? Maybe I will go back there. Still doing that. Okay. To investigate it, we look to the profitability using abnormal operating performances, a tool already used by some authors, which is just comparing two pairs of issuers, trying to match them with the best matching possible. And we are comparing the performances after the issue, before and after the issue. We calculate both realized performance, so you have the expected performance is a performance realized by your matched pair, your matched bond issuer, you have the Sukuk issuer, and we look to the relative variation of performance. So the expected performance you may have as a Sukuk issuer is the variation of the performance of your matched bond issuer. So just to look to both the level and the trend of the performances of both Sukuk and bond issuers. Okay. So if you look to profitability using EBITDA, what is striking here? There is no differences. But that's actually, if you think about it, because when you get this type of results, you say, crap, I don't have any significant results, cannot publish it. But if you look at it actually, it's perfectly logical. The issuers are putting aside some asset from the balance sheet. So it's normal that in the EBITDA, you don't have any impact of the Sukuk because it's outside the asset, the balance sheet. The impacts may come afterward on the return on asset, when you take into account the interest, for instance. Just here, we can see that there is a slight decrease on the third year after the issue of the relative performance. So maybe after some years, the results are coming back to the firm, coming back to the balance sheets, because you don't have any more performing projects. You have put all your performing projects in SPV structures. Looking to the return on assets, we have another striking result that strikes us, actually. The Sukuk issuers are much more performing than the bond issue. Really, they are. If you look to before the issue and after the issue, they are really more performing. They are brilliant when you compare to bond issuers. So our interpretation that these issuers are mature firms on the market. They are performing the market. The question is, why are they going to the Sukuk market then? And if you look to the variation expectancy of the Sukuk issue, you can see this time a decrease from the second year. So this means that, okay, they are better there, but the rate of their outperforming is decreasing time to time after the issue. So it looks like it's not the Sukuk which generate this abnormal performance, but the Sukuk may have, it's not causality here, may have an impact after some years on the variation of the performance. It's slowing down the company. That's the way you can see it. And last, just to say to the free cash flow here, we have slight evidences, but very slight, of a bit retention of free cash flow, but actually nothing very showed up here. So Sukuk issuers are similar to bond in terms of EBITDA. They have a higher return on assets, but this outperformance is decreasing time to time after the Sukuk issue. The question, so we have lots of robustness checks. I will not take time for that. And the question is it because of the Sukuk issue? Because here just comparing pairs. And even if we control for lots of things by matching these companies, we do not have something more robust. So the next idea is to isolate the impact of the issue on the issuer performance. Typo here. For doing that, we follow Noel and Taran and others who do a panel regressions, and we have dependent variables, profitability and free cash flow, and a key variable, which is just a dummy Sukuk bond issue. So if you issue a Sukuk, it's 1. If you issue a bond, it's 0. And we control, because you are working on residuals, so you have to control for lots of things that may impact this difference of performance. So here, issue level control, macro level controls, heteroscedasticity, and so on. If you quickly look to the result, here I just show the variable of interest. If you look to the result, you can see that on EBITDA there is still no impact. Okay, all right? Slightly a difference between the two dummies here, but it's not really important. Okay. If you look to the return on asset here, we may have something more interesting. The last year, again, we have a slightly decrease in the performance due solely to the Sukuk issue. But still, it's not very clear. And our interpretation, we don't want to overemphasize the results. Our interpretation is that it's very difficult to make this causality link because it is SPV outside of the company, outside the balance sheet. And we are comparing balance sheet to an instrument which is using an SPV, and which is putting away some assets. But if you look to bond, there is never any impact of bonds. So we may say that Sukuk has a slight impact. Here it's not significant, but almost. But bond has never an impact on the performances, on the operating performances. Okay. Okay, so the results are Sukuk do not impact the profitability based on EBITDA, but it hampers slightly the return on asset the third year, and it leads to a retention of free cash flow. What we can say is that this underperformance takes time to impact the issuer, and it's only a marginal impact. And the reason for that is the very reason, this very way the Sukuk is structured, through an SPV. It's our interpretation. And our question is, either Sukuk is used for less performing projects, so you have this adverse selection scheme, either it is due to more hazard from the management, which is monitoring the projects. These questions we cannot easily answer because data on SPV are not available at all. Actually, almost every SPV are structured in fiscal haven, like Bahamas or Virgin Islands and so on, for legal cost reasons. Another way to see the performance is to look to the stock market and to generate buy and hold abnormal return, comparing it to the buy and hold abnormal returns of bonds issuer, and to look what's happening time to time. And if you look, this is very straightforward actually. The return of companies who are issuing Sukuk, this blue line, are really decreasing, but it's a buy and hold abnormal return. That's normal. The slope is not correcting itself. That's totally normal. But the gap is increasing time to time, and you can directly link to the fact that they issue a Sukuk here. So here. You can see here the statistic for buy and hold abnormal return, and here the regression, and you can see that you can attribute it to the fact to issue a Sukuk, which is totally in line with the impact of the Sukuk on the profitability, or at least the fact that it is based on slowing down companies. So maybe it's not the Sukuk which is generating the abnormal return, but Sukuk are issued by slowing down companies. That's the idea. And it's not easy to disentangle between the two explanations, actually. We just stop there because we cannot dig deeper. Data on Malaysia balance sheets are not that wonderful as US data. So we did a lot of robustness checks, and we have this result. Yeah, I'm on this. I'm on the sum up. So what are the effects? Sukuk are issued by more performing firms, and that's a striking result for us. We didn't expect that. So the adverse selection scheme does not really happen on this issuer, but it's issued by declining firms, and it generates a retention of free cash flow. So it also generates a negative impact on the long-run stock return. So maybe it's the projects that are chosen by the Sukuk, which are not that good as the projects underlying bond issued. That's our interpretation, and maybe there is a more hazard scheme due to the structuration of the Sukuk. So it seems to be a bit less performing debt instrument. It may impose firm value, and reducing the legal and agency cost of Sukuk, and presentation this morning may have help in that way, would be an important step to develop the Sukuk market. Thank you.
discussant now, please.
Sorry.
What is it? There is a software. Don't close it. Just minimize it.
Mic is working?
It should be red.
Okay, let me also thank the organizers for allowing me to be a part of this conference. I very much enjoyed reading this paper and learning much more about some of the securities in Islamic finance. So the question that the paper is after is, how does the issue of sukuk differentially impact the firm's performance relative to the issuance of standard debt contracts? Okay, and so one of the things we want to be careful of is, and this came up a little bit in the previous presentation, is the issuance of sukuk causing differential performance versus is the issuance of sukuk reflecting that performance in the future is going to be different? Is there a signaling component, or is this actually causing a change in the activities of the firm? And what they're going to try to do to look into this is to look at a few different measures of firm performance. So we're going to look at the short-term stock market reaction, we're going to look at measures of operating performance, free cash flow, and then the buy and hold returns over 3-year time periods. Okay? And so what does the paper find? Well, somewhat consistent with some of the existing literature, it's found that when the bonds are issued, there's a positive realization by the stock market, whereas when sukuks are issued, the response is negative, and that difference is statistically significant depending upon the time period that you look at. Moving on to operating performance, what's found is that at least when we get out 3 years, and that's when you start to see that there's a reduction in EBITDA, even though there's an increase in ROA 3 years after the sukuk has been issued relative to having issued a bond. Okay? And then finally, what they look at is the buy and hold returns, and what they find is that if firms issue sukuks, then after 3 years, there's been a significant decline in the performance of the firms that issue sukuks relative to having held the Malaysian index, whereas bond issuers perform positively, and that difference, again, is statistically significant. Okay, so that's a review of the results. What I want to get into is what I think has not only been an issue in this paper, but kind of more broadly in some of the papers that I've seen. And that is that when we're thinking about sukuks, right now the way that the paper is set up is there's this dichotomous choice. Either firms issue bonds or they issue sukuks. Okay? And so the issue that I'm having, though, is, and this is to some extent brought up by the author, is that these are not perfect substitutes with bonds. There is this profit-sharing component that makes them different from the standard fixed income security that we think about for bonds. So what I want to instead think about in the way that I teach corporate finance to my MBAs is that we think about security. You could think about pure debt being at one extreme of a continuum. You can think about common equity being at the other extreme of a continuum, and that financial engineering is about creating these contracts that exist in between the continuum. And I think about these sukuks as lying in different spaces along this continuum, depending upon the extent to which there is profit sharing. And so from my reading, you have contracts like Ijaro that are more like leasebacks, which very much sound very similar to a standard debt contract, and so I've got them pushed more over towards the left near debt. Whereas the Mudaraba seem to have larger profit-sharing components, which means that they're going to be much more like equity securities. Okay, well, if that's the case, then I don't really understand why we're treating these things as equal to each other. If there's variation within the different types of sukuks, that should be taken into account in the empirical design. But then the other thing that this graph kind of demonstrates is, while we can think about comparing them to debt, shouldn't we also compare them to equity issuances? Okay, so my suggestions for the authors in terms of sample selection are, number one, shouldn't we take into account this variation within Sukuks? But then number two, if we're going to test an adverse selection story, which is implied but maybe not as explicit in the paper as I'd like it to be, if we're going to test an adverse selection story, then as you move from no profit sharing to full profit sharing, as you move from all debt, pure debt to pure equity, then you should see that the performance gets even worse. There should be a monotonically declining impact on long-term performance. But the paper doesn't allow for a full test of that because the equity issuance reactions aren't in there. So I'm suggesting that rather than solely comparing to straight debt issuances, perhaps we should also compare it to straight equity issuance and see whether or not we get this monotonically decreasing effect on performance as you move in, as you increase the amount of profit sharing. Okay, couple other issues, and also in line with some of the things some of the other discussants have mentioned, is we need help with the institutional details. So when I understand kind of from a US GAAP-centric accounting perspective the difference between EBITDA and ROA, but again, because I don't understand how these SPVs work within the Sukuks, I don't understand exactly what's missing or how this differential accounting treatment works when I go from a debt issuance to a Sukuk issuance. So, you know, my understanding from the presentation was that the ROA measure is going to be after the interest expense on the bond issue, but it's not going to be after the profit sharing on the Sukuk. Well, but that's going to cause this apples to oranges comparison where I can't really understand how much of the performance difference on ROA is because the actual activities of the firm have changed versus under ROA, the interest expense has been taken out, whereas the payments on the profit sharing to the SPV have not been taken out. So providing a lot more of that institutional detail would help me better understand why I'm getting this rank ordering. Is it that the firm has done something different, or is it that the accounting for what's been paid out is causing this difference? Those have very different economic implications. Okay? Then when we move from ROA to cash flow, again, I need some help with the definition. So when I think about free cash flow, not only is it after the payments to the debt holders, but it's also after I've made investment expenditures. So when we see that free cash flow is higher, is this solely because we haven't made the SPV payment, or is it also because these more mature firms are engaging in less investment following a Sukuk issuance than the firms that would have issued debt who are still growing and investing? So what is the source of the variation so that I can understand the economic channel through which Sukuk provides different information to the market than does the announcement of a debt issuance? Okay, and then finally, we're told that Sukuk issuers are different than bond issuers. Well, but does that mean that they should have the same buy and hold returns? Again, I'm not an asset pricing person, but what that tells me is that the characteristics of Sukuk issuances are different than the characteristics of bond issuers. Therefore, the amount of risk adjustment that I would do on the Sukuk issuers should be different than the amount of risk adjustment I do on the bond issuers. And so it's not clear to me that for either the bond issuers or for the Sukuk issuers, because of these differences in characteristics, it's not clear to me that for either of them, the benchmark security is the Malaysian stock index. There needs to be a risk adjustment if I'm going to actually determine whether or not there's actually a risk-adjusted performance differential.
Professor, 2 minutes.
What's that? 2 minutes. 2 minutes, perfect. Okay, because that brings me to my concluding slide. The paper has really interesting data, and I think that it's going to allow us to better understand how variation in cash flow rights differentially affect performance in the market's response to that issuance. As I mentioned before, we normally have run this on US securities. We've thought about it, and to some extent a dichotomous choice. There's been some work has been alluded to by prior discussants that we might think about convertible bonds as a third choice. Well, one of the nice things that these Sukuks offer is they offer an even larger menu of choices. And so to the extent that we want to better identify how different cash flow sharing arrangements are differentially responded to in the market, then there's much more richness within the set of Islamic securities that are issued than we see in more conventional securities. And I'd like the authors to better take advantage of that differentiation. Again, their results seem to be consistent with an adverse selection story, but I think the addition of the equity responses could even further substantiate that channel. And again, I'd like to say that I think that you could take this and move it beyond just an explanation of Islamic financial securities to actually tackling a first-order question in finance, which is what is the underlying relationship between the variation in cash flow sharing rules with the amount of market response and adverse selection that we see. So frame the paper instead of focusing on Islamic financial securities to asking this big picture question about financial markets where you have more richness than we've previously had. Thanks.
Thank you very much. Take a couple of questions from both sides of the hall. So anybody here? Oh, please. I'll give him the mic. Excuse me. Professor Dawud.
I listened to both presentations from the author and the discussant, and I had several questions in mind when I was listening to the presentation of the author. But the discussant has basically raised all of those questions that I have in my mind. But the only thing that is left on my list of questions that I had is when you're looking at the return on asset of a firm, so thinking like an accountant, so when you issue a sukuk, basically you take off some of the assets from the balance sheet. So that will reduce the number of the total assets on your balance sheet. So the immediate impact should be a better return on asset. So the kind of relationship that you are seeing doesn't match with the intuition. So I would say maybe you might have to look a little bit further into it, what has happened, whether the assets were really transferred from the balance sheet of the firm or whatnot. And beside that, maybe you also have to look into the structure of the sukuk. So if you know the structure of the sukuk, then you would be able to find out whether it was an ijara sukuk, the assets were transferred or whatnot, or if it was a musharaka or mudarba sukuk. Otherwise, like just by comparing may not give you the real insight. Thank you very much.
Yeah, just one comment about the operating performance, which is like 1 year, 2 year, 3 year ahead operating performance. Why not looking at the analyst forecast for this next 2-3 years, and how does it match with that? I think that will be a better measure of performance rather than just looking at this kind of, as there is a opportunity for accounting manipulations and return on equity. So look at the analyst forecast, and so about their operating performance.
So we want to move on to the next paper. This paper is on determinants of corporate leverage in public listed GCC companies. This is, who's going to present? Khatib. Yes.
You have to adjust it? Okay. This you can put it in your pocket.
No pocket.
Where's the mic? Or if you like to come on the stage.
No, I don't like the stage, but I think I should put this.
Yeah.
Okay.
Mic.
Just hold it?
Yep.
Okay.
Or if you can fix it here. Yeah. It's the other way.
Assalamu alaikum. I'm Rawan Khatib from Zayed University, Dubai. And it's my greatest pleasure to present my paper today, which is entitled...
I think you should look.
Okay. Assalamu alaikum. My name is Rawan Khatib from Zayed University, Dubai, and it's my greatest pleasure to present in front of you today my paper, which is entitled Determinants of Corporate Leverage in Publicly Listed GCC Companies, Conventional versus Sukuk. So I will start my presentation with a brief introduction highlighting the motivation behind the paper, and then an overview of the research objectives and the research contribution, a quick look at the data, and then moving to a discussion of the major empirical results, finally concluding with some further research ideas. As we are all aware at this stage, that Islamic finance has been growing rapidly into a boom in the past few years, with increasing global bank penetration rate and with higher growth in Islamic banks compared to its conventional counterparts. So based on Thomson Reuters' State of the Global Islamic Economy Report 2015-2016, Islamic finance assets are projected to reach $3.25 trillion by the end of 2020. And actually, at the third quarter of 2014, the total value of the global sukuk outstanding was $312.3 billion, with 34% growth compared to 2013. In fact, if we look at this chart, this is just to give you an idea of the massive growth and the total value of the global sukuk outstanding. If we look at the comparison between year 2008 to the third quarter of 2014, we can see how sukuk has increased from around $38 billion US dollars to $312 billion. Actually, tapping into the sukuk markets is considered one of the strategies that will enhance even more growth in the Islamic finance market, and thus it's very important to understand what derives sukuks and to understand more about sukuks. However, so far, even with all this witnessed and expected growth in Islamic finance and in sukuk, we can see that we have very few and very limited research in sukuk specifically, if we're talking about theoretical or if we're talking about empirical research. So that was actually the major motivation behind my research, which is to explore this area and to try to contribute to this area, which is very critical for the growth of Islamic finance, yet it is under-researched. There are several corporate finance studies that explore and examine what are the determinants of the conventional leverage in publicly listed US companies. And those studies have been actually extended to include many international countries. And we have consensus from all those studies that there is a set of financial variables, a robust set of financial variables, that could be used in conventional models or in any other models to explain the firm's financial choice. So basically, my objective in this research paper, it's very simple and straightforward as follows. First of all, to study the determinants of conventional leverage in publicly listed companies that are based in the GCC countries. And then, since we have this huge debate and argument about whether sukuk and bonds are different or similar, if in fact, sukuk are similar to bonds, then we should expect that the same determinants by corporations to include conventional leverage should also apply when we're talking about including sukuk in the capital structure. Why did I choose the GCC firms? In addition to the fact that I work in one of the GCC countries, also, of course, GCC countries facilitate and allow the issuance of both conventional and Islamic finance vehicles. So that's why it's an advantage to study GCC firms. And there has been a large contribution of the GCC countries when it comes to the sukuk markets. In fact, Saudi Arabia and UAE have ranked in the second and third place globally with respect to global sukuk issuances in 2015. Now, why did I choose corporations specifically? This is giving me a hard time. Why am I choosing corporations specifically? Because if we look at the GCC market in year 2014, 43% of the total bond and sukuk issued in the GCC was issued by corporations. And here we're talking about corporations excluding the financial services and government entities. Yet, there is again almost none. Research talking about publicly listed corporations, especially if we're talking about the GCC. So my research contribution comes from two strands. On one hand, I'm talking about contribution to the general corporate finance literature, where I try to identify the determinants of conventional financial decision in 3 fast-growing GCC countries. This paper will help provide the policymakers with an understanding of how to develop opportunities that can help promote growth in the corporations' respective industries. On the other hand, this paper will also contribute by shedding the light on this area, which is not researched a lot, which is the sukuk. And this area is critical for the development and growth of Islamic finance. So this will help us understand whether really sukuk are the same or different from the conventional bonds, just like the paper that was just discussed now was trying to show. There has been some literature now trying to show whether sukuk and bonds are same or different. So my data is actually from Zawiya, Thomson Reuters. I use a sample of publicly listed corporations in a period spanning from 2005 till the end of 2014. I exclude the financial sector. And my final sample includes 191 firms with 61% based in Saudi Arabia, 28% in the UAE, and 11% in Qatar. I will jump immediately to the empirical results, and what I'm basically testing are 3 major hypotheses. So my first hypothesis is simply the financing decision of GCC publicly listed firms can or cannot be explained by the same conventional variables that are used in the literature. In order to test this hypothesis, I follow exactly what traditional literature does, and I am testing it here under 4 different scenarios. Those are the 4 columns that I have. This is part of the table, just to make it clear. And in my first column here, I'm using the debt to market equity as the dependent variable. In the second column, it's the debt to book equity. In the third column, it's the long-term debt only to market equity. And in the fourth column, it's the long-term debt to book equity. I'm actually controlling for all the traditional variables that are used in the current literature. So I start off with tangibility, which is the ratio of fixed assets to total assets. And as you can see, we have the positive significant coefficient for tangibility, where we expect that because whenever you have more fixed assets, that is going to support the debt as collateral. For the market-to-book ratio, which is the Tobin's Q ratio, I don't have that strong results here, but actually in current literature, there has been a debate on what market-to-book actually measures or proxies for. But once it's significant using the debt-to-book equity, it was significant positive, which is consistent with the pecking order theory, and this is actually what all the other results are consistent with, which is the pecking order theory, and this is what we expect in GCC firms since they are all tax-free, operating tax-free countries. When we come to size, we can notice also significant positive coefficient because large firms are more reputable, so they have lower information costs. We can see that we have a significant negative coefficient for profitability. Again, this is consistent with the pecking order theory, and that the firm that has more investment opportunities. Financial deficit, which is the Shyam, Sanders, and Myers measure, is weak here. It's insignificant. And again, this is consistent with recent literature that financial deficit might differ depending on the sample, depending on whether the firms are paying out capital or receiving capital. So in my case, it was insignificant, which is fine. Firms that are larger and firms that tend to pay more dividends are also going to have less corporate debt, and again, this is consistent with the idea that they're going to have less investment opportunities. So overall, from those models, we can conclude that the traditional conventional variables are the same variables that could explain to a high degree the financing decision in Saudi Arabia, UAE, and Qatar-based companies. The higher the tangibility, the larger the size, the lower the profitability, the younger the firm, and the fact that the firm doesn't pay dividends, the higher is the component of debt in the firm's capital structure compared to equity. Now moving to the second section, which is, let's see if we can use those same models to explain whether those factors are also relevant to how much the companies are going to include as sukuk in their capital structures. And I also add a third hypothesis, which we cannot ignore at all, which is the fact that, remember here we're just talking about corporations, not banks. So it's not easy to go and say, this is an Islamic bank, this is a conventional bank. So in order to understand that the companies are going to be issuing sukuk because they are simply conforming to Sharia regulations, so I am going to hypothesize that the companies that will be using other Islamic investments or other forms of Islamic short-term or long-term financing, I expect those to have a higher proportion of sukuk in their capital structures. So in testing those models, in this table, actually the first two columns kind of similar to the columns that I had in the previous table. However, now my dependent variable is the sukuk to market equity in the first column and sukuk to book equity in the second model. So the Islamic transactions variable here is the indicator that's testing my third hypothesis here, which is set to 1 if the firm will have other Islamic investments or other Islamic short-term or long-term investments, financing. And of course, it's significant and positive. However, I'd like to inform you some important statistics, is that 73% of the firms that had sukuk also had other Islamic investments or Islamic short-term or long-term financing, which is why we have this significant positive coefficient. But what I thought is more interesting is that 88% of the firms that had other Islamic investments or other Islamic short-term financing did not have sukuk. So those are the firms I think that we need to look at more closely to understand why would those firms not tend to issue sukuk, although they are conforming to Sharia, they are using the other forms of Islamic financing, but they're not issuing sukuk. So going back to this table, you can see now all other factors are no longer significant except for size. So size is still a major determinant for issuing sukuk. Age is only one time significant. And so we can say to a reasonably good degree that we cannot use those conventional regression models to estimate the sukuk. So what I try to do, this is some kind of trial to kind of identify, is the decision of issuing sukuk related to the decision of issuing debt, or are they completely separated out? So what I do is I include a new variable in columns 3 and 4 called excess leverage. What does this excess leverage mean? If we go back to the previous table, the last two columns, long-term debt to market equity or long-term debt to book equity, since we can compare sukuk more to just the long-term debt rather than the total debt, I compute the residuals from those models. So those residuals mean this is the amount of excess leverage that the firm has taken rather than the amount that should be taken as predicted by theory. And then I use this excess leverage in those models to see if the firm takes up excess leverage, either more or less than what it should in theory, will this affect the decision of taking sukuk? And in fact, I find a highly significant negative coefficient on excess leverage, which means that if a firm takes on more leverage than predicted by the financial variables, it will take on less sukuk. So what does that mean? As we have seen from this table, firm size is the only significant financial determinant of sukuk utilization. Having other Islamic instruments, such as short-term or long-term investments or financing, is significantly positively related to sukuk utilization. But there are other factors that are not captured by the conventional regression models, which significantly impact the sukuk utilization. So an overall conclusion here is that the conventional regression models fail to explain the company's decision in utilizing sukuk in their capital structures. Hence, this could suggest and add to the literature that the sukuk are not the same as conventional bonds. But, of course, further research needs to be done. since we need to give more consideration into what those factors are. This research is still preliminary, so I want to try to investigate more what are those factors that are affecting the decision of issuing sukuk. Specifically, a starting stage would be, of course, to control for agency issues and for corporate governance variables such as the board independency or chair duality, board size, and that kind of variables. That's all. Thank you.
Discussion, please, Professor Kabir Hassan.
Well, let me start with congratulate the author. I believe she's the only female presenter here. So gender equity, we're trying to go that direction. Mr. Chairman, you're my friend, so I may take 1 or 2 minutes more, right? Just kidding. By the way, we went to school together, graduate school. The author investigates the determinants of capital structure behind publicly traded companies, 3 GCC countries, Saudi Arabia, UAE, and Qatar. The first confirmed the conventional factors are valid for their sample of GCC countries. They then test the proportion of sukuk equities correlated with these factors. And finally, they test if a history of Sharia business practices can explain the use of sukuk. So the author finds capital structure decisions in GCC countries can be explained by conventional factors, and these conventional factors are unable to explain sukuk. However, firms with the history of Sharia practice hold more sukuk. Now, actually, very good. So we have a data set. We have the sukuk and conventional debt. There's a lot of studies done in the US and the Western countries, the determinants of capital structure. She borrowed that model framework and just implanted into a sukuk. And that part, and she found first hypothesis and second hypothesis that the same factors can, relatively speaking, that the same factors are some way determinant of these both types of sukuk. Now, she has mentioned that one of the paper seems to have already investigated hypothesis 1 on this paper. It would be benefit to starting point to see how her paper is separate from this Spady paper as more of a resource. Besides these 2 additional countries, why would your result be any different? Now, I'm a little bit surprised that she only looked at GCC, only 3 countries, but there are 2 other papers. The 80% of the sukuk are issued by Malaysia, and Malaysia is pretty much absent from it. Having said this, I do have a serious, the motivation of this thing is sukuk a different asset class than bond. And all the discussion for the last 2 days, including 2 papers, the sukuk is a different asset than bond. We need to really establish this. But unfortunately, the sukuk that exists in the market right now, there are different fatwas, 85% of the sukuk are not Sharia compliant. So it is like a, pork sandwich wrapped around with some hummus. So make it halal. So now I will not be surprised if some of the results that in earlier, like it's a negative reaction or no reaction, the sukuk issuance versus bond issuance, because these are not really different. Now, one of the discussions before me said that we really look at this in spectrum, from the debt, ijara, musharaka, mudaraba. So that distinction somewhere needs to come into place within our discussion with your analysis, just to show that really this is a different asset class and it will behave differently than the others. Now, of course, we can borrow from the conventional literature, like, determinants, but we have to really show within this one set. So we have the firm issuing both bond and issuing sukuk, and we have to see really sukuk some sort of does behave differently on the profitability of whatever way you would look at it. So that part, it needs to be. So what I am really finding that is a lot of work has been done, the motivation, why I'm doing this, what purpose I'm trying to achieve by doing this exercise. So that needs to be done. By the way, I know Rawan, she is a very prolific, very accomplished author. She has a JFE, so she knows all the techniques. So I hope she will look at these things in a positive way. The motivation and contribution behind this paper is unclear. You first want to know the determinants capital structure found in US applied to GCC. Then you want to see if those variables can also determine Sukuk equity. The question that needs more elaboration is, what do we gain by knowing why firms choose Sukuk in their capital structure? The current evidence seems to show the only reason firms choose Sukuk is the fact that firms have done an Islamic transaction in the past. Now again, that claim, some way, from the data is not clear really. Where is this variable that you say that, okay, it has issued some sort of Islamic instrument before? In the regression, I did not quite see that, or maybe I missed it. So when you make this claim, that claim has to be substantiated with the data that you have. Beyond the motivation, there seems to be little theoretical background for why the conventional variables would explain Sukuk. More explanation behind why conventional variables could possibly explain Sukuk would benefit the story. So we need a storyline here. We need a motivation, and in corporate finance, motivation is important, storytelling, and you have done this before, the one. So you have to look at this. Table 1, because there are only 3 countries, it would be nice to see the number of firms broken down by each country. Adding a new table would not be burdensome. There should be summary statistics showing the amount of Sukuk issued by companies and the characteristics of Sukuk issuing companies. This also helps explain the results in Table 4. I believe it is important to note in a paper the Sukuk is considered long-term. Long-term in nature. This should make the paper more accessible to readers. There are no robustness tests. So you have run a series of regression. You could have done more magic doing this panel regression. So these kind of tools that you already know and in your toolbox, so you should try those. By the way, that point probably I missed is the difference between government Sukuk and corporate Sukuk. But here you're dealing with publicly traded Sukuk issued by the corporation. So government Sukuk doesn't come here. The robustness check that would include a dummy for government ownership, the model used in table for me, interesting as well. Having said this, you have looked at only firm-specific characteristics. You really did not go beyond firm. Here you're doing emerging markets, there are different environmental factor, governance factor, and there has been a lot of work has been done. Many authors are doing right now that looking at beyond the firm-specific factors. So as an extension, I would say that in addition to determinants of capital structure using Sukuk, you really need to bring the other factors to see whether that also makes a difference. Very reason why there are Sukuk concentrated in a few countries, like 3 countries you said, Malaysia, but beyond this, there are not really many countries which is using Sukuk. For example, Bangladesh, 20% of the market is Islamic. There's not a single Sukuk issue there. Why is that? There might be other environmental, legal, governance, all these factors. Unfortunately, the data, you have to dig the data and bring it together. It would be nice to say expand a discussion why only 3 countries. There are data, as I said. Maybe data takes time, but we can always do that. Why not test more GCC countries and include these new countries? Literature has shown that conventional factors work in the US in addition. Literature has also shown that factors work in other countries. However, these studies consider one country faces one legal regulatory environment. So when you bring all these 3, for example, even the Sharia, if you look at the Sharia compliance of Sukuk in Malaysia is different from Sharia compliance in GCC. One good thing that you do not suffer from it, but when you bring all these countries, that the Sharia orientation will also make a difference, a Sharia risk kind of thing. So you need to bring that aspect into your analysis. So these are some of these, just minor points. But I want to say how you can, in addition to what you said, that how you can extend this. You can look at the contribution should be further developed, motivation. Benefit motivation is stronger theoretical background. You can really have to establish whether Sukuk is actually a different asset class than conventional bond used by these firms. The data section could benefit from expanded summary statistics. So there are 4 points I want you to see for expansion. First, accessibility to Sukuk market is essential for choosing Sukuk issuance. And other determinants do not promote the use of sukuk unless this requirement is satisfied. Bangladesh, zero sukuk. Why? Accessibility is not there. The government is not really conducive, in terms of rules and regulations. So that part has to be. Some we need to bring this picture into your analysis. Second, the low degree of financial constraints of firm promotes the sukuk issuance once the required condition of issuer accessibility to sukuk market is satisfied. You have to bring that thing into your calculation, into your analysis. Third, undervaluation of the firm in pre-issuance period also encourages sukuk issuance once issuer sukuk market accessibility condition is satisfied. And finally, as you mentioned, somewhere, the corporate governance factors issues also have an impact on the decision to issue sukuk, so you really need to bring them in. Good start, little more work. Hopefully it will be published soon. Thank you very much. Hey, Osama, I'm within limit. I finished within limit, time limit.
Third paper, Piety, Politics, and the Portfolio Selection. Professor Bailey.
I would like to thank first the organizer. Thank you very much. And also for the hospitality. It has been a pleasure actually for the last couple of days being in here, in this palace. So the topic that I want to cover in an hour, just kidding, piety, politics, and portfolio selection. This is an ongoing project, and this is really the rough result that I'm going to be presenting. Although it's rough, we have a lot of things in the paper, and the paper can be divided into multiple sections or multiple paper, but I would like to give you what we have so far so you can get the big picture. So now, before I go into the details, so I just wanted to motivate what we are doing and why we are doing, okay? So in the literature, we already have that behavioral biases are very important for the investor in terms of investing in the stock market. So although the conventional finance theory assumes that people are act rationally, as I told you, there are a lot of behavioral biases. And some of these biases has been already explored in the literature. And the religious, politics, and culture are mostly the ones that has been explored in details. So in this paper, we have a very simple idea. What we are trying to achieve is the impact of piety, how religious you are, in terms of the investor and the corporate financial decision making. So basically, how religious you are, how it is going to be affecting the investors' investment decisions, and also how it is going to be affecting the firms as well. Okay? So now, in terms of the piety, we are particularly looking at the Islamic finance. Why we are looking at the Islamic finance, not the other religions? Because of the interest in Islamic finance. As it was said yesterday, the market side of the Islamic finance is becoming $2 trillion. And this morning, I think the previous speakers was mentioned, by 2020, it is going to be $3.25 trillion. So we're talking about a huge market. So therefore, it is important that we do more research in this area to understand both the firm level and also the investor level information. Now, also, another thing why we have to look at the Islamic investing is not because of the market side, but also because of, Frank mentioned yesterday, Islamic financial institutions are less prone to the systemic risk. Therefore, it might allow us to prevent the next crisis as well. So because of that, we expect to have less default risk for these companies. But the problem is now it comes with a cost because the market is not well developed yet and it is not liquid. Because of that, the investing in this market can be costly for the Islamic investors versus the conventional investor. So now we're basically going to be analyzing this question for the Islamic financing angle, but then the laboratory that we are going to be using is Turkey. So why are we using Turkey? Well, Turkey is an interesting setting for our study, in particular because of its unique economic and cultural and historical and political setting. So that's the reason why we are going to be looking at Turkey. Now, again, why in Turkey? It can be more reason. Well, the more reason is coming about this political angle. Because if you look at when the Ottoman Empire was dissolved right after the first, World War I, almost 80 years later, the new party was in power, okay? And during that almost 80 years, it was Atatürk's party, the founder of, Turkish Republic's party. It was the Republicans' People's Party, Cumhuriyet Halk Partisi, okay? And they basically, historically excluded the socially conservative people in the politics, and including all the institutions, government institutions as well. So there was a reaction against this party, and then in 2002, Justice and Development Party, which is a conservative party, basically won the elections, okay? So because of that, you can also look at the Turkish map, and you can clearly see the division between the supporters of those two parties as well. So if you look at the Turkish legislative election in 2011, you can clearly see the political and cultural divisions in terms of the geography of Turkey. For example, the west part of Turkey, those the red areas, this is the European side of Turkey, and this is the Asian side of Turkey. And also the Asian coast, they are heavily populated with the supporter of the Republican People's Party. But on the other hand, the Anatolia, which is basically this area, is historically more conservative people. So therefore, you can see that division of the people as well in terms of the supporting of the government as well. Now, in terms of this, there are some the red areas in here, but there is a reason for those, because in particular these areas are right here, those two areas is heavily populated with the Alevi people, and they are very secular in Turkey. So they are basically supporting again, the Republican Party. On the other hand, the southeast area is heavily populated with the Kurdish people, and they are independent. So you can clearly see the political and cultural division in terms of the vote, okay, in Turkey. So now what we are trying to understand is, we have a sample, we have a unique proprietary data that nobody has actually. So we're basically using that data in investor-based data, and we know the location of the investors coming any region in this map, and we are trying to understand their investment decision, okay? And also we know some of the companies that they are investing in the stock exchange, so we would like to understand what are those companies and what are those characteristics in terms of if there is any cherry picking or there is clientine effect in terms of matchmaking between the investor and the companies as well. So those are the big questions that we are still exploring. But to scratch the floor, we just wanted to look at two things. One is the characteristics of the investors, in terms of Islamic versus the conventional investors. And also the second is the firm level, characteristics of the Islamic firms versus the non-Islamic firms, just to understand. Then in the later revision of the paper, we are going to look at this, clientine effects. Now, again, the focus of the paper is basically twofold. One is compare investment decision and performance of Islamic versus conventional investors. The second is measure apparent piety of listed Turkish companies and associated differences in performance and other characteristics. Okay? Very simple. Well, later on, hopefully once we have more data, we would like to also analyze in more detail in terms of the not political connectiveness of the firms, but we would like to understand how the behavior of the firms after 2011 elections is particularly changed. So maybe the firms, they find that the environment is changing and they become immediately more Islamic to be able to allow investors to invest into their the companies as well. So, but again, this is nothing to do with the political connectiveness of the firms, okay? Because our intention is really to understand how the behavior of the firms over time is changing as well, or adapting to the market conditions as well. Now, the big question is, how are you going to identify the Islamicness or religiosity of the investors and the religiosity of the firms, right? So, I mean, if I have no, clear cut in terms of identifying those, then I could have an excellent, I don't have to do a lot of things, okay? So basically, we are using a different kind of proxies to identify the religiosity, basically. In
Professor,
terms of,
2 minutes.
Huh?
2 minutes.
12 minutes.
To 2 minutes.
You're kidding.
Well, he hasn't started yet.
I think you are just cutting my time because you have given in to the previous speakers. Okay. All right, okay, I'll follow it. Okay. So in terms of the religiosity of the investors, we are basically, we have this 25,000 individual investors coming from a random sample, okay? And we basically know a lot of information about these 25,000 individual investors, which broker house that they are investing, and then their locations, their, position in terms of the wealth, how much stock that they have invested. Basically, we know their wealth, okay, over time. So basically, we use one proxy in terms of the measure the religiosity is choice of the brokerage house. So there are a couple Islamic brokerage houses. So we basically identify if you invest through that brokerage house, then we call you as an Islamic investor. Then we also look at there is a Islamic index. Well, in Turkey, they don't use Islamic bank or Islamic index because it's all about participation. So the Islamic banks are called participation banks, and also Islamic index is called participation index. So we are looking at that participation index, and if you are investing in that participation index, then we are calling you, Islamic investor. We have different methods of looking at, since I know your portfolio position, so I basically look at what percentage of your stock portfolio is invested into that index stocks. So we basically have different cutoffs, and then in terms of defining your Islamicness, basically, for investing this index. Then also we look at a very crude way of understanding, Islamicness of the investors by looking at, since we know the demographics of the investors, where they live, we try to understand the voting patterns in the region that the investor is living. Remember that map that I showed it to you? So if you are coming in one of these, or the bluish oranges, the location, then we are defining you as an Islamic investor. Of course, as I told you, it's a very crude, way of doing it. Now, in terms of the corporations, we define the piety in terms of, again, 3 different measures. If you are in that index, if your company is in that index, then we define you as a religious company. Then we also define you as a religious company if you are ever exposed once even to Islamic bond market scoop, or if Islamic way of financing. Then our best proxy, to be honest, is in Turkey there are different kinds of business organization. One is called the Muslim organization, businessman organization, which is called Müsiyat, and the other is the more secular one. It is called TÜSİAD. So depending on which organization group that you are belong to, we identify you as an Islamic or secular as well. This is really the better way of getting the result. One problem, I don't want to call it, it required a lot of hand collecting data because it turns out to be TÜSİAD companies is publicly available information. We know who are those TÜSİAD companies. Müsiyat companies, we approach them many, many times, and it's really a closed box. Nobody tells us, what are those companies. But then Çağrı, basically one of the co-authors, he's a PhD student. He did a lot of hand collecting from the magazines and newsletter. So the findings, although I just wanted to give this before I go into the details, which I don't know if I am going to have time. In terms of the investors, what we are finding is basically Islamic investors display conservative characteristics as we were expecting. So what are those conservative characteristics? Well, they are less prone to overconfidence and disposition effects. Those are basically behavioral biases that is well documented in the literature. And also, they have more local biases. Basically, what does it mean? If the headquarters of the company that you are investing is within that region that you are living, you're basically more loyal to these companies. So that's basically the local biases that we are finding. Other characteristics include higher narrow framing. What does it mean? Basically, it's clustering effect. So you basically don't look at the portfolio effect of the stocks that you are holding in your portfolio. So you basically look at the, disentangle that stock, and then you look at that stock per se. Now, also what is important is monthly alpha is lower for Islamic investors. Remember one of the things that I mentioned to you before, Islamic investors are really very loyal, and they are looking for places to invest their money. Even though they might or they might not know, they end up getting a hit in terms of getting a low return. Okay? So what we also find out, we wanted to understand, regardless of differentiating between the Islamic investor versus the secular investor, we say let's do a factor analysis using all the the variables that we have. We basically rotate those factors and then apply the factor analysis. This is interesting. We find out, regardless of identifying your religiosity, we find that the Turkish investor, in general, impassioned, experienced, pious, and they invest into lottery stocks. So what does it tell me? It tells me that piousness is very important. So although it is only the third factor that is explaining in the factor analysis, it is still important. My guess is, if they increase the market shares of the Islamic companies in Turkey, that might even go back to a higher level. Now, in terms of the firms, what we are documenting is secular firms are significantly larger than the conservative firms. That makes sense because there are not many Islamic firms in Turkey. Return on equity is lower for Müsiyat, which is the conservative firms, than the secular firms. What is more interesting is the PE ratio, and there is an and there. PE ratio and asset growth is higher for Muslim firms, religious firms, than the secular firms. That basically suggests us that those are growth stocks. So that means potentially there might be more growth opportunity for these, non-secular firms. Now, our paper is literally, as you can see, is touching the three strands of the literature: culture and finance, religious economics and law, and individual portfolio decision, which I'm not going to go into this in details. So the data, how many, do I have a couple? Thank you. I'm bargaining now. The data. So the data is amazing data, to be honest. So what we have, as I told you, we have the daily trade and the position. And this is a random sample. We can get a hands of the bigger data set, but using a 25,000 random sample data is enough in terms of helping us faster computation as well. And also, we also know, as I told you, if you have traded through this Islamic brokerage house as well, okay? In addition to that, and the data spans from 2008 to 2014, 4 years of data, and including individual investors' demographics characteristics as well. So we know a lot of information. Now, and in terms of the stock price data, we got it from the regular places. Now, in terms of the Scoop data, we used the Deal Scan Thomson 1 and STC, whichever we were able to find, we got the data. And the interesting thing is there wasn't a lot of Scoop issues. I think it was around 11 or 12 Scoop issues that we were able to identify. Now, in terms of the behavioral biases, as I was telling to you before, we don't want to create something new behavioral bias. We just wanted to use what is available to us. So basically, use the disposition effect narrow framing, and in particularly overconfidence in addition to lottery stock preferences and local biases. One thing that I have to mention is disposition effect is basically investor relative willingness to sell the winner rather than the loser stocks, as you know. So basically you react, you know, if you are making money immediately to sell the winner rather than the loser stock. For the narrow framing, as I told you, you basically ignore the portfolio effect when you are looking in one particular stock in your portfolio. Now, overconfidence, what we are using for the overconfidence is basically we are using Warren's, Bailey, Kumar, and Nink's JFE paper way of identifying. Overconfident investors are those with the most frequent trading and the worst performance, okay? Now, the lottery stock preferences, we are using the definition as Kumar 2009. So those lottery type of stocks are really the penny stocks we're talking about. And those are the ones which exposed to the high idiosyncratic volatility and idiosyncratic skewness as well. Now, in terms of the local biases, as I told you, we are trying to understand, you know, as an investor, you have a tendency to invest in the firms which their headquarters is within the region that you are living. So we created a proxy for that. Monthly ratio of number of locally headquartered companies the investor holds to the total number of companies, okay? Now, in terms of the investor religiosity, as I told you before, we're using one for the brokerage, and then the second one is the Catalan 50 index, and we are also using a different ways of, you know, creating proxies for the Catalan 50 index. Then also we are looking at the political leaningness also, meaning that the number of votes that, you know, the AKP is won, and we're using that as a proxy also for the religiosity.
Professor, can you wrap it up in a minute?
All right, so I have 14 different tables, so and including we did some, you know, adjusted, you know, risk analysis. So we look at the Sharpe ratio and one factor. So the bottom line, I don't want to bore you. So again, so this is basically what we are finding, okay? So I'm glad that I put those summary pages in here. So the Islamic investors, I think this is the one slide that you can take away, you know. Islamic investors display conservative characteristics. Once again, they are less prone to overconfidence and disposition effect and more local biases. And also, as I told you before, monthly alpha is lower for Islamic investors. And again, overall in Turkey, the investors are impatient, experienced, then pious, and then they invest into the lottery stock preferences, okay? And for the firms, there is a significant differences between the Islamic firms versus the secular firms. Now, what are we going to do next? Well, there are many things that can be done. I don't want to hitchhike, you know, teams, you know, discussion, but one thing is, you know, we can separate this analysis into different papers, okay? And the second thing is, you know, we are trying to understand also more in detail the Catalan 50 index, because right now, the size of the firms which is in this index is big, okay? Therefore, we would like to know over time, you know, some companies go into that index and some companies get out of that index. So we would like to also understand, you know, which companies going in, which companies are coming out, so then the investors' behavior are changing or not, okay? Because those are going to basically tell us the religiosity of the investors. And another thing that we would like to work on is, as I told you, we would like to see if there is a Clementine effect or matchmaking particularly, is after particularly in 2011, if the behavior of the firms has changed. The secular firms' behavior should not change. So therefore, we are going to use the secular firm as a control group and then see the Musiat firms, which is the religious firms, if after the election, if there is a treatment effect, if there is some kind of, you know, changes in those groups, okay? And then they basically affected also the investors as well, because they might end up, you know, getting more Islamic investors, okay? Anyway, I'll stop in here.
Thank you very much.
Yeah.
Discussant, Professor Tim Adam from Humboldt University, Germany. use your
Yes,
time
okay.
a little bit.
So
I'll give you 6 minutes.
6 minutes, okay. Thank you very much. Okay, so first of all, thank you for the organizers to give me the chance to present this paper. Can I have this? So how does this work? Okay, very good. All right, so since I'm standing between us and lunch now, as I was just informed, I will do my best to make this quick. So quickly, what's this paper about? It's about investor behavior. The authors want to look at how Islamic investors relative to conventional investors, trade stocks. But the paper also has a second aspect, and that looks at whether there are differences in firms that are Sharia compliant versus conventional companies. There are a number of results. Basically, the authors find that Islamic investors are less subject to all kinds of behavioral biases. But nevertheless, their investment portfolios performance is worse than that of conventional investors. And as far as companies are concerned, Sharia-compliant companies, at least as far as the paper was concerned that I received, are larger, more leveraged, and overall perform worse than non-compliant companies. Okay, so what I think are the really strengths of this paper, the strengths of the data. The data is really fantastic. They have 25,000 randomly selected investors, and they know a lot about these investors. They know the daily stock trades of these investors. They know the size of the positions they're taking, the buy and sell, the timing of the trade. In addition, they know something about these investors. They know the age, the sex, the portfolio wealth, investment experience. They have proxies for that. They know the location of these investors in Turkey, so they can distinguish between city and rural investors, and they can also distinguish between the political environment. So I think this is really fantastic, and I also think that the general research focus is very interesting. We know too little about how Islamic investors trade and invest and how they differ from conventional investors and what the impact on the portfolio performance is. So I have three quick comments. The first one is I think the paper would benefit a great deal from providing a better focus on one research question. So right now, the paper looks at behavioral biases of Islamic investors. The paper looks at the portfolio performance of these investors, and they look at what are differences between Sharia compliant firms and conventional firms. And it's not really clear in the paper how all these three things are connected. And what I suggest is to give a better focus. So for example, one way to position the paper is to focus on the question, so how do Islamic investors invest, and what is the impact of those investment strategies on portfolio performance? Why is this interesting? Because Islamic investors may limit themselves to just a subset of stocks, so that should actually lead to lower performance. On the other hand, as the paper shows, Islamic investors are subject to fewer behavioral biases, and so that could actually provide kind of the basis for better performance. So then it's an interesting empirical question, so which of these two effects will dominate? So the paper does answer some of these questions, but not in this context. And one thing that the authors, I think, need to do more directly is, so what stocks do Islamic investors actually invest in? Okay, so is it really true that Islamic investors limit themselves to a particular set of stocks, like from this Katilim index? Okay, and another thing I would find very interesting is if you look at trading behavior. So do Islamic investors pursue more a buy and hold strategy, or are they more traders? Okay, because all of these things could also impact performance. My second comment is about identification in the paper about Islamic investors. So you're using three different methods. The trades conducted through a particular brokerage house, whether the portfolio of these investors are dominated by Sharia-compliant companies, and the city in which investors reside in. Okay, so if the city the investor resides in votes, if more people in that city vote for the AKP than in Istanbul, then these investors are coded as being Islamic. Okay? So I think the first identification using this broker is the most interesting one. The paper talks about kind of some particular brokerage house without actually revealing who it is, and I'm just kind of wondering, is that kind of a secret, or can that actually be revealed? But more importantly, my question is this brokerage house unique? Okay, so if it's not unique, then of course you need to add other brokerage houses to your sample to make this identification clear. The other thing that you show, or that you argue in this paper, is that non-Islamic banks are avoiding this particular brokerage house. So why is this important? Well, the question is, are non-Islamic trades channeled potentially through this particular broking house, broker or not? And so my question really is, why would that be the case that non-Islamic banks avoiding these types of brokers? Okay.
Professor, 1 minute. And I'll conclude with a very short comment on the issue of sukuk, if you don't mind, Professor.
Okay. My last comment is about identification. So it's of course interesting to look at, what do Islamic and conventional investors do? The problem with this sort of identification, of course, is that we cannot rule out that there's an unobservable factor that drives both, these guys being Islamic and having particular trading patterns. What we would really like to have is some exogenous variation in, being Islamic, which is probably not available. Okay? So, however, the data set is really fantastic, and so I would like to encourage the authors to look more at potential exogenous, variation in the data, and to see whether that could be used to address similar research questions. So here's one example. So if you look at the question, does Sharia compliance, does this matter to investors? Okay? So one way maybe to get at this is to look at variation in companies that become Sharia compliant versus non-Sharia compliant. So you have this Katilim index. You show that the membership of this index changes frequently. So you could look at inclusions and exclusions of this index as, quote, exogenous events, at least exogenous as with respect to investor behavior. And then look at, take your treatment, the Islamic investors and as a control the conventional investors, and then see how Islamic and conventional investors react to this inclusion and exclusion of this company from this particular index. And that would tell you whether
Professor,
being Sharia compliant would actually be important.
Could you please wrap it up in half a minute? We are really past our time. I'm sorry.
Okay. And so this could also then continue. You could actually ask, whether the inclusion in the index will shift the investor base more towards Islamic investors, and I think that would also be an interesting idea. And so that's the comments that I had. So I overall enjoyed this paper very much. I think it has great potential, so I wish you good luck. Thanks.
Thank you very much. This has been a very interesting session. I have a very short comment on the issue of sukuk. The word sukuk has been used quite loosely to denote any kind of syndicated Islamic finance, whether negotiable or non-negotiable. Strictly speaking, debt contracts are not negotiable from a Sharia point of view. You cannot issue negotiable sukuk when it comes to murabaha and tawarruq, for example. Okay, so the researchers has to be attentive to such violations. 2 years ago, I was attending a seminar on the issue of sukuk, and one of the practitioners that belonged to a major consulting company told the audience that most of the floating sukuk are really bond actions. That's just not much different from bonds. This is really bad. So I think maybe the researchers in this area may want to look at summaries of the nitty-gritty of the contracts to see to what extent are they similar or dissimilar from regular bonds. Also, the researchers may want to look seriously into the potential of using sukuk for the conduct of both fiscal and monetary policy. I believe sukuk could present a viable substitute for conduct of open market operations in the conduct of monetary policy. Now, central banks in advanced countries are not only purchasing government bonds, but also corporate bonds. So why not Sukuk or even stocks? Thank you very much. We'll resume at 2 o'clock. Thank you very much.